Welcome back to the 2022 Master Trader Program with Mark Minervini. My name is Bob Weissman, and this is the question and answer session following our day 3 curriculum. I do want to just remind you that we'll answer as many questions as we can. There are more than what is possible, just like last time, but we do try to get through and aggregate as many of the common questions as we can. We will have more time for another question and answer session on Monday during the live trading day. Also, I know a number of you, of course, are Minervini private access members, where you do have access to Mark every week for live question and answer sessions there. So do keep that in mind as well, that you certainly still have, the ability to ask us questions. But we also want to get started with today's questions. We have Mark and Mark here to answer the questions you have been submitting. And with that said, let's get Mark in the frame there. Good. All right. And with that, Mark, any comments, or ready to jump right into it?
We're going to go to different pages within the workbook as you've asked questions and asked questions. So we're going to go jumping around in the workbook, and that's how we normally do the Q&A. Give you guys a chance, and for the future session also, if you're on a page in the workbook, you have a question, write it down, and then we can address it later on.
Yeah. So if that's the case, Mark, then why don't we start picking up from the workbook on page 261, okay, which is where we did start the day.
Okay.
And the question being asked is how to identify wedging up within the pattern against a VCP pattern, since wedging up would be a characteristic that we're not looking for in a name. How would you define or differ a wedging up on that right-hand side versus
wedging up is just what it says, wedging up the right side, where instead of drifting back and having some shakeouts, you just sort of move up the right side. We don't have examples. So unfortunately, if you could come up with a chart that had an example. Now, some people think something like this right here is wedging up. That's not wedging up. That's moving sideways. That's actually a perfect pivot. But again, this failed shortly after. That's why you always have to look, even if they look perfect, you don't know if it's the market or some surprise news comes out. And blast the stock. So if you get those violations, even if you get a perfectly formed pivot point coming out of a base, even in a bull market, you still got to respect that risk and get out. With regard to your question of wedging up, I don't see I'm having many examples of wedging up here, because we're showing you the examples that I traded, some of the better examples, and I'm not going to be buying wedging up. I'm just trying to see if there's anything here that shows any type of wedging up. But again, that's a minor detail on the right side. You would also look for time compression. Wedging up very often is in conjunction with time compression, and you'll come up that right side, and the base will look compressed on that right side. So it all sort of forms that overall look of the base.
On page 267.
267.
Is this an example of a base failure or a pivot failure?
So this would be an example of, and this, I guess a good example of this, I'll show you a real life example to find it here. Bob, if you look for Dick's Sporting Goods, if you can. So this is where you set up nice and tight. So now you're in that nice VCP, right? You're getting all excited here and you're ready to buy it as it breaks out. And maybe it even breaks out and sticks its head out. But then you have the pivot failure, right? The pivot failure would be the low of right here, of that tight area. So that's a pivot failure. Now it comes down and it takes out the low in the base. That's a base failure. So if you got a pivot failure, sometimes it can retighten. That's what I was showing here, that, stay with the count. You can have where something like, where was it? Where you have a pivot failure.
Is Dick's. Okay, 292 is Dick's.
Okay, I'll get to that. So you have that pivot failure, but then it resets and it turns around, and that pivot failure is still, from peak to trough here, is tight enough to have that VCP still be constructive, because you're still within that single digits, and you've moved tighter. So just because you have that pivot failure, and sometimes it'll even tighten up even more. So in this case, where you're pointing out in 267, this is a full-blown base failure. And a lot of times what will happen when you get the full-blown base failure, it just takes longer for if it's going to reset, it'll take longer to reset. And because it's a larger base, you might get the low cheat. You might get a cheat and a handle. You might get a bunch of buy points up the right side, because as you run into that supply, you're gonna stall out, and that's what creates those pivot points. 292, yeah, right here. Yeah, see, this is a perfect example where you set up and you stay nice and tight, right? Then you come off and you take out the low. Now you've taken out the low in that base. That's a base failure. But now it comes ripping right back and then retightens. This is a much better base now. Now it's a nice double bottom. You undercut. You had a great quick shakeout here. It came ripping right back, and you got really, really tight in a weak market. Market actually went to lower lows, and now it comes out. That's pretty much textbook of what I was pointing out on that slide.
While we're on this slide, there's a question asking if you would be missing it, but I remember reading it, so I'm going to paraphrase. But he wanted to know, would you be able to buy the stock on that gap up to that $20 area? Would that be an entry technique?
Well, you
on
could
this
buy it.
side?
You can buy it wherever you want, but I wouldn't. I wouldn't buy it there. Again, I'm not sure what workshop you just watched, if that's what you're asking me, because that would be with no right side development. You're talking about right here on that day up, no right side development, compressed right side, and would pretty much defy everything that I just spent days telling you need to look for to build that right side. And again, this is where I think you need to get off the buy low, sell high. Remember, I said you don't want the lowest price, you want the right price. So you're looking at it lower and trying to figure out how you could have got on earlier. That's the thinking that gets you into a lot of trouble, and you need to get away from that and forget about getting on early, getting off the lows. You want to get the right price. The right price is the price at which the lowest risk point, where whether you're right or wrong very quickly. The stock's acting abnormal in a very tight risk range, because you don't want to risk too much, but you need to be able to know if this stock is acting normal or not, and the price to pay for that. Okay, the price to pay for that is, it's like again, I'll bring it back to poker. If you've got to wait until the last card, you got to wait for the river to find out if you're right. And that's when you bet big on a drawing hand and you got to draw out, versus knowing right away that the hand's no good. You can throw it away at the cheapest possible price. So you don't want to put all that money into the stock or try to play the proverbial poker hand and put all this money in until you've got a solid hand. I want to play aces. This is not, it might turn out to be where you got in lower, and in hindsight, but the probability is that this is going to stall out. It's going to take time. I mean, it did take time. It went a little bit higher and you would have gotten in lower, but it's just not ripe yet. The right price is the price at which the stock moves very quickly from that level and lets you know whether you're right or wrong from a high probability setup.
All right, let's go to 269.
269, all right.
Question here was on the X, if you could explain the 1-2 punch again.
The 1-2 punch is just simply when the volume dries up, and then on the breakout, the volume comes in, and you see really big volume on the breakout, but right before the breakout on the day before, the volume is really, really low. And you can see that happened here. When it first tried to break out here, the volume was low. Then the volume, excuse me, I just ate something real quick before we started. Wolfed down a quick lunch. The volume comes in, right? And then even over here, when it reset, see it resets in here. See how it gets real tight? Look at the volume comes way down. And then as it comes out, look at that gigantic volume. That's the elephant getting in the bathtub. When the elephant gets in the bathtub, the water has to rise. There's no way to hide it. And that's why we watch volume and we relate it to price.
This is a good example too, Mark, of the difference, because you just showed the base failure. This is a pivot failure reset. And you highlighted how in the Dick's example, it took about 2 months for that to really reset up. This was about, maybe 1 to 2 weeks. So that just highlights the difference between the two.
Right. And what Mark is bringing up a very good point, where the pivot failures will usually reset in a very short period of time. If they're going to reset, it'll happen in a couple of days to a couple of weeks, usually 1, 2, 3, 4 days to maybe a week, 2, sometimes 3 weeks. When you get a full-blown base failure, it's going to take longer. And that's why I was showing those diagrams and just showing how it will not only take longer, but then when it takes longer and it's deeper, you're likely to get those multiple buy points off where you get the low cheat, the handle. You might have more opportunities at that point.
Okay, on 270, next page. Question being asked, why not wait until the price breaks out from the base as opposed to where you're buying them? It seems like there's too much supply on the left-hand side.
Well, yeah, if you always, when you're buying the pivot, or if you're buying from a cheat, and you're not set up right at the highs, you are going to have supply to the left. That you're absolutely right. But that's why we're waiting for the real tightness in price and the low volume, because that gives you an indication that that supply stopped coming to market. That's the whole reason why this is happening. As a matter of fact, there was a question I saw. I don't remember. I read it somewhere in the chat. Why are tight closes important to institutions? So that's like, let's relate that to this question. Why is this tight price important to institutions? You see, that's just the opposite. Actually, this isn't important to institutions. This is the footprints of institutions. This is the footprints of, and this is where people don't understand. Well, why is it tight? If institutions are buying it, how does it quiet down and get tight? Shouldn't it be more volume and moving up? No, because the institutions are sucking up the volume. They're absorbing that short-term supply. And the supply starts the supply stops coming to market because they take all that short-term, like you and I, we're weak hands. We're short-term. Mark Ritchie and I are weak hands. Like if the stock goes down 3 or 4, 5, 6, 7%, we're out. So we're weak hands. But if the stock didn't have anybody to absorb that, if there was no institutions in there buying, then a whole bunch of retail traders like us would just clobber the stock. So the fact that it absorbs that supply, that's the footprints of institutions in there buying and retail money getting sucked up, and that supply getting wringed out, like that towel I was talking about, the water. So it's not the cause, it's the effect. This is like the most important thing that you could understand. Once you understand this, these charts won't just seem like drawings and hocus pocus. You'll realize that it doesn't happen because the chart sets up. The chart sets up because it happens. You understand? This is the law of supply and demand. If you were to chart anything, any auction market, you'd make the same patterns. You would make the exact same. It doesn't have to be stocks. It could be anything. If you had enough buying and selling and enough volume, and you charted an auction, an art auction, you would. We've done this with various things and charted auctions and found that they still based and broke out and had tightness in price. This is something I did way back when I first started using these charts and wanted to understand how supply and demand work. It's timeless, and again, these are the footprints. But anyway, let's get back to your question and the chart. So if you draw a line across here, and let me just get this here, as we keep saying about drawing lines, you should always draw a line from the pivot to the left if you want to understand how much supply is really there. When you look at this, all right, it looked like there was a lot of supply to the left, but when you look at what's above that pivot, there really isn't. There's 1, 2, 3, 4, 5, 6. There's like 8 days. Only 1, 2, 3, 4 days where it closed above that level. All right. And there's only like 8 or 9 days that it traded above that level. The majority of the price action is below that level. And that's why it's quieting down right there. This is what Livermore referred to. And Livermore was so far ahead of his time because there were no charts and computers and none of this. And he figured this out just by watching the ticker tape. Watching the ticker tape, he figured out about price and volume and time and how supply not coming to market and what he called the line of least resistance, forming the line of least resistance. This is the line of least resistance. Once you suck up that supply. Now, if this happened higher up here, let's just say it happened right up here and it was tight right here, that would be even better. And that's where the lowest price isn't always the right price, because the higher price, once you cleared that, you would actually clear all the supply. And that would give you even a better indication, because now you have all happy buyers. Nobody's stuck. You don't have any trapped buyers. Nobody's stuck in the stock anymore. So the supply is eliminated. So once you understand that, but remember, when you're in a cheat and you're trading below the highs, yes, you're going to have supply. That's why it's important to look to the left. And like I said, you can simply draw a line and see how much it traded above there and how far away it is. The further away it is and the less amount of time that it traded above that level and the shallower the correction is, the stronger it is. So you got to take those things, and there's no formula for this. It's not like, well, depth times time, minus days above the line. I mean, you could probably come up with a formula, but I've never been able to come up with anything that's really as accurate as just looking at the chart.
Related to this concept, question is asking about institutional selling that happens off exchange or dark pools. Is there any way that you're able to see the bigger boys transactions if they're not on the exchanges?
They are on the exchange. They show up in the final volume. Yes, they do. So that's a myth, that there's this volume that's hidden. It all gets reported. So it all shows up in the volume on the chart.
Yeah. All right. On 273, question being asked, could this be, this was the point. So, all right. Could this be considered a double bottom?
It is a
Actually,
double bottom, yes.
And this is where the question was if you could be buying it from the $20 point. So this was Dick's also, so same chart.
No, because a double bottom, once again, doesn't mean that you buy it coming off of the low. I mean, you could, if that's your entry technique, that's fine. But I haven't found that entry technique to be one that's reliable.
On 320, page 320, question being asked about in a power play, this did not demonstrate having low volume before the breakout. Is this less relevant in power play setups?
Yeah, I'm not sure how this volume is scaled, so it might not be as like all this volume. It might be scaled where it's peaking here. So I'm not sure. I'm pretty sure the volume did come down relative to the volume within the base. So I can't say for sure on that. So I got to look at that, but I'm pretty sure the volume did come in there. It might be the way it's scaled. Sometimes if you hit logarithmic versus arithmetic on the scale, and there's a lot of volume, and they're also sometimes the volume when it's real high, they'll put a peak on it, and it's like a limiter. It puts it across the top, and then it all looks like all the volume's the same. I'm not sure about this one. I'd have to look.
All right, on page 328.
It did come in, for the record. It didn't dry up massively so, but there was a contraction of volume in the last one I just checked.
Yeah. And again, that's something you're going to look for. And when you get into a stock that is really, if you were to look at that on Google or Apple, you're not going to see that dramatic contrast. You may, there's times where you may, but their volume is going to be a lot more even. And then you're going to have to look at it a little bit more subtle and take that into account, that you're in a very crowded trade with a lot of institutions in there. Again, I try to buy small mid-cap stocks if I can, all things being equal, or even larger stocks that are not super high volume traders. And that's where you find the inefficiencies. And that stock did trade, I think, a lot of volume. Let me just see. But there was definitely a contrast in volume. Yeah, what did this trade? Well, actually, this only traded about 800,000. So that's actually nowadays, that's actually low volume. What was the other page?
328.
Yeah, 328. Yep. Go ahead.
Question here was if you show how you added it to the focus list after it already moved out of that first pivot area 28. If you had seen it or it was on your radar, could you have bought it at that breakout of that $28 area?
I did see it and I just didn't buy it. And then it started moving and I put on the focus list because it looked like it was, it was going to go. And that's, probably the reason I put on the focus list and not buy it, because it already had moved through there. But yeah, I mean, this is one that I did see and I just didn't buy.
Then the question is, a follow up to that is, if you bought it at the $40 level and let's say it stepped up and then created another tight base, at what point would it be just too extended to be buying it? Could you keep doing it if it continued to move higher and higher with each succeeding compression area?
Yeah, well, that's more of an O'Neill type strategy, and that would be the type of thing you'd want to do with a stock that had the big earnings and really you got to really try to spot, a key leader, and usually coming off of a bear market in a new uptrend, because as you get later and later, if you're doing this late stage and you start buying late stage bases, you're definitely going to get disappointed. So in an early turn like this, excuse me, in an early turn like this, it could be a good idea to do that. But now you're playing a different game there. You're playing a different approach, because now what you're doing is you're adding shares to a profitable position and you're raising your average cost, and you'd have to play for a much bigger move at this point, because you're kind of defeating the purpose of buying it at 20 something and selling at 40 and making that nice profit. Well, now you're adding to it. I would add less shares. That's one thing. That's something that O'Neill used to talk about too, is as you pyramid up, you add less and less shares, so you don't run your average price up too much. But if it keeps building bases, Taser did this even with the power play, built 2 or 3 bases before I even bought it. And then I think there was 2 more after that. It was 5 bases in a row, and the stock went up 12-fold before I even bought it. And then I think it was 20 or 30-fold after, from the whole move. So yeah, you could do that, absolutely. And sometimes you look at a stock like this, it moved from 10 to 30, it's up a couple 100%. If it tightens up right here at 40, it went up 300%, but it's still a power play. It's still a power play. If it's not extended from the base, you can certainly trade it. But as you start counting those bases, realize it's becoming more and more obvious at that point. There's chances that there's more retail trading in there. Retail trading is more fickle. It's not that institutional strong money. And now that the volatility starts picking up, and that's where you start getting whipped around. But you have to look at the volatility and see if it's still high alpha, low standard deviation. High alpha, low standard deviation is simply where you've got a stock that is in a strong uptrend, and there's not much downside. It's mostly upside or flat trading, and you can just see how efficient this is moving up. So as long as it still has that high alpha, low standard deviation is coming out of a base, yeah, you could keep trying to trade it. Absolutely.
Back just 2 pages to 326.
326. Yep.
The question here was relative to not choking off a trade too quickly on a power play. At what point would you, what multiple of your risk would you want to look to tighten your stops without fearing of choking it off? And the comment that he's making is, with the hard penny environment this year, he's been doing it much shorter than what would be traditional for him at just 1R, well before the 2R type of range.
Yeah, I'll turn that over to you, Mark. You talked about the power plays and giving them more room and so forth. Maybe you can speak to this one.
Just for clarification, Bob, was he saying even in the bad environment, should we not choke them off? Is that correct?
Well, that was his follow-up, but his main question was generically speaking, but then he was referencing this year being so hard penny that he's been tightening his risk very quickly.
Which is, obviously given the environment, that's the absolute correct thing to be doing. And I look, like I said all things being equal, when these trades are working, I don't want to be selling them too soon. And then I have a general rule though, that I don't choke these off at all. And the reason, meaning if it hasn't really gotten going yet, I'm not gonna switch from a 6% stop to a 4% stop. And the reason for that is because they're so powerful. Whatever little bit I'm saving by moving a stop up or potentially choking off the trade doesn't pay. Remember, if we do this 1,000 times and you choke off one power play that goes on and doubles, how many 1 or 2% savings do you need to account for that? So, and again, this was born out of the evidence of my own trading. So I just saw there were a few that I had choked off and then they just blasted off. So I was saying, based upon the math, I'd much rather just give it the stop and let these stop you out.
Now, mind you, if you are underwater, okay, and you are down whatever a percentage that is, putting pressure on you, let's just say, you're down 8 or 9%, you're starting to look at a double-digit loss in your account. Well, at that point, I might play it safe, and once the stock moves up and I get it out of the gate, I'll probably sell some, take a little profit off, and then give it some room and either finance my stop or choke it off at the break-even point. You might want to do that, but see, again, it's going to be a personal decision based on your risk tolerance and where you are currently with your own trading. A lot has to do with where you are with your own trading. If you're going to make, I don't make big moves and bold moves unless I've got profits, and certainly I've got to at least not be underwater. If I'm underwater, then everything changes as far as the risk that I take and how conservative and how safe I play it. I have a very simple rule. It's when things are going well and I've got profits, I'm more forgiving. And when they're not, I'm less forgiving, to the point at which the worse it gets, the more I'm being a total stickler. And I'm not worried about missing a stock. Like Mark said, well, you'll choke it off and it'll go higher. That's true. It depends, though. If I'm in a situation where I'm down, that's really not my concern. My concern is just chipping up, putting myself in a position to take advantage of something like this. And even if I have a partial position, I'm okay with that. See, I've been doing this so long that I don't Monday morning quarterback. I could care less if the stock goes up tenfold and I got stopped out. I'm going to analyze it very unemotionally and objectively and take a look and go, okay, that's interesting. Let's see what happened there. How can I avoid that next time? And I realize that there's a million trades in my future, and that it's not going to change anything in my return if I miss a stock here or there. What's going to change it is if I lose lots of money. If I'm down and I compound my mistakes and I'm losing money, losses, as I've shown you before, and we're going to get really deep into in risk management. Losses work geometrically against you, and that's your first line of thinking. So like I said, it's a relative decision. But generally speaking, you definitely want to go the Mark Ritchie path with this, and you want to give these the benefit of the doubt, because they can be, that's why they're called power plays. They're very powerful. As pharmacyclics is a perfect example. There's one, we made a big return on it, but it went on to go up, thousands of percent, and even more than that in the 43 months, up 26%. That ended up getting bought out and went even much higher.
Question Mark is asking if you're able to define a pivot point, how it's figured out. Is it an exact price or a zone? And finally, is it the top of the most recent time compression, or could it be the prior peak of the start of the consolidation?
Well, we covered this in quite detail, so I'm not sure. The pivot point is the top, is the level that you're going to decide. I mean, the pivot point is defined by you, is defined by the chart, but it's also defined whether, if you're buying a pullback buy and you're using the previous day's high, that's the pivot point. If you're buying a breakout from a base and it's going into new high ground, well, it would be the high of the pivot, of the tight area, as you said, and it might line up with the highs, but it might not. If you're buying a cheat, it's going to be the high in that last contraction. But generally speaking, it's the high in the final contraction. In the final contraction is your pivot. That final contraction where I'm suggesting that you keep it at single digits, when it takes out the high of that contraction, that's the pivot point. Unless you're using a pullback buy or some other technique, it will usually be the high of the previous day, or the high in that tight area.
Also, a couple of questions all related to that. So what is the number? Is there a minimum number of days a pivot can be from which you would be buying?
Yeah, that's a good question. I mean, it could be one day. It could be, that's what we call a pause pivot, 1 or 2 days, a quick pause. But it's still, you have to take a look at the chart and see, have you gone through those iterations of tightening? And if it's fine, if you've gone through a bunch of iterations of tightening, and let's just say the previous tightening was over, I don't know, 5, 8, 10 days, was from 20 down to 19, it was 5%. And now you paused for a day or two in a 2% range, that would be enough, that one day. Again, the best way to do this is to look at there's hundreds of examples in this book, and you've got examples in my books, my published books. And then you even have examples in O'Neill's books, which are going to be, I think he uses more weekly charts, but with all those examples, that's what you need to look at, and start looking for charts that look like those examples. That'll be your starting point.
Also, if a stock were to gap up through a pivot, how far above that buy point would you still be willing to buy it?
The same as always. I don't want to buy them more than 1 or 2% above that. And on a gap, I might buy it. It depends where it gapped from. Like if the pivot was, let's just say 8%, and the previous day it would close near the lows, and it gaps 2% above the pivot, that would be like 10% that's up on the day. So that would affect my decision as whether if I bought that gap or not. But let's just say the previous day was right near the high, and now it gaps above the pivot. It's 1% above the pivot. It's on a 2.5% gap on an earnings announcement. I'll probably just buy that. I would buy that gap. That's not a real wide gap. It's not up huge on the day. So again, if it was coming off the lows, it was a big up day, and it came a long distance, it was a big gap. Then it wouldn't matter just because it's up a couple percent above the pivot, but it's a real large gap. You have to be careful because a lot of times they come in, they close those gaps, and the more bigger that gap, the more you're likely to get volatility. So again, you got to look at the chart.
On a power play question being asked, if you look at the institutional sponsorship in the owners funds section on MarketSmith, or is that too lagging for that to be important?
Well, it is lagging. It's very lagging. It's 3 to 6 months of lag. So you can get an idea of what happened previous. And what I will generally do if I look at that, and I look at the institutional sponsorship has gone up, I'll look at the chart and I'll relate it to 3 to 6 months back and see what happened over those 3 to 6 months and prior. So if it's 4 quarters, I'd go back 3 months or so and then sort of overlay it in my mind's eye over that, because what's happening now is not in those numbers. So that's just the way you have to think of it. I don't know, Mark, and this is being related to power plays, right, Bob?
Yes.
Directly? Yeah. So Mark, with power plays, are you ever even considering the institutional sponsorship at all?
Not at all. That's way too lagging in terms of power plays. You really just want to focus even more so on the price action than the fundamentals at all, in my opinion.
Right. See, the thing with a power play is when you truly get one that sets up properly, because there's a lot of stocks that blast off and they're just not really proper power plays. Even O'Neill has said that, these are patterns that happen, a few times in a year or in a cycle. And now you seem to see, people calling it a power play or a high tide flag, on every stock that moves up. So again, to get them right in a really well-defined power play that meets the criteria is rare. Again, that in itself, that type of powerful price action, like I've said before, tells you something's going on. Whether it's in the institutional sponsorship, the earnings, whatever it is, the fundamentals are kind of irrelevant at that point because the price is so strong that it's saying, hey, something is definitely going on here. It's just a matter of it's going to continue. So again, it's like you're creating that asymmetric leverage. If you were to put yourself in a position where these stocks that something's going on, let's just say, I don't know, 20% of them go on to go up a lot more, and there's this much upside on average. Well, if you buy them from these tight areas and there's only this much downside, well, even adjust it for, that 80% failure rate, it may be a very profitable situation because there's so much upside versus the downside. The key is if you managing that downside in relation, but you're putting yourself in a situation that's the potential to be a big winner, and that's the key. With the power plays is and the fact that the other thing that's very important is that the whole reason why we don't want them to go down more than 20% is because that's saying that there's very strong hands in the stock, and any supply that's out there is getting sucked up. Stock goes up 100% in 3 days and can't correct much. Well, that's telling you it's super strong, and that's really all you need to know with these.
Question being asked on does MarketSmith calculate the percent compression of each time period of the VCP? Or do you have to manually calculate that?
Oh yeah, no, I don't know. I'm not sure. I don't know of any VCP indicator. They do have a pattern recognition, which I don't use, but I'm not sure about that. It'd be good to ask Scott Sinclair. I'm sure that they don't have a VCP recognition, but they do have pattern recognition, which would lead you definitely to charts that were tight on the right side. They are looking for tightness too, but not directly related to VCP per se.
Yep. Question being asked, when Mark is indicating I bought here on each of the stocks, can he assume it was during a strong bull market, or did Mr. Minervini often buy when IBD's big picture might have been uptrend under pressure or market in correction?
Well, I mean, there's going to be, it's going to be all over the place. I mean, I can't tell you that if IBD was uptrend or under pressure when I was buying going back, I don't know, So I'm not really following that, to be honest with you. I follow the market myself, and I am looking for accumulation distribution days, but I make that the conclusion myself as opposed to watching IBD. But IBD would be great to watch because they're not going to be too far off track. That's for sure.
All right. On another concept question being asked here, what is the rationale for why closing price is so important? Are institutions buying late in the day?
I'm not sure I ever said closing price was so important. So I'm not sure where you heard that. I didn't say that closing prices were that important. As a matter of fact, we talked about, squats and reversals and not selling if it even closed on the low and broke out and then squatted all the way down, waiting for reversal recovery. So I'm not sure where you're getting that. I mean, yes, a strong close would be great. That shows that the stock has been able to absorb any intraday short-term selling. Once again, weekends, stock runs up. Let's just say stock breaks out today, runs up, 5-8%. And at the end of the day, runs up and ends up closing up 12%. Well, that shows that even that elevated price that would generally run into selling, some short-term selling, it was absorbed, and that the stock was able to have even more buying come in after it went up and absorb any short-term selling and overcome it. And that would be a sign that, you've got some real buying in there.
Quickly, just the definition of the widest spread, what that means on the charts.
A widest spread simply means that we're in, that would be in selling, which is where, let's go there. Yeah. Let's go find that so we can have a chart to show what that looks like. So widest spread is simply your low to high range, or it could be even a gap. So for instance, here, as this stock's running up, you can see right here, this day, right, and this will happen, you'll get the largest up days and the widest spreads when a stock gets extended. And after it's up 70%, I look at 2-3 weeks of trading, and I look for when 70% of the days are up versus down. So that could be 8 out of 12 days up. In this case, you're 8 out of 9 days up, and you start extending here, and now you get gaps, largest up day, widest spread, and it's up 47% in just 4 days. This is getting very climactic. This is like what Mark was talking about with the plane going up, and eventually it's going to stall because it just can't keep that angle. Or someone running up a mountain, they run faster and faster. They just can't, it's not sustainable. So the widest spread, you'll generally see the largest up day and the widest spread on an extended stock, usually within 1 to 3 or 4 days of a peak, especially if the stock is really extended. So you want to sell. Once you get that, that's sort of like your warning that, okay, start selling, and any strength from here, just sell right into.
Right, one page before, on 378, in middle August, there was a shakeout day with the stock dropping through the 50-day, recovering that.
Right here, yeah.
Question, which I'm paraphrasing here, is that an example of a base failure or a pivot failure, and what would be the reentry, if any, on that opportunity?
Well, I don't know. I mean, there's really not an entry to begin with. So I'm not sure that, when you say re-entry, where would you have entered? I mean, there's really nowhere to enter in the first place. If you want to call this a little pivot right here and you've got a little VCP, yeah, but it was pretty short. I mean, that wasn't that big, but it was enough to to play, if you wanted to play a little small base, and you did get a pivot failure, it never broke out. So the problem with this is what we would refer to as a Hardaway crossover. Hardaway crossover is when you undercut the pivot or the base, and then the stock moves right back into new high ground without setting a pivot. And usually it'll happen within 1, 2, 3, 4 days, sometimes 5 days or so, but it happens very quickly where you just don't get a chance to get back on board because it never sets a pivot. And then it just wedges up here. So it just gets away from you. So like Tim Hardaway used to he'd go left, he'd go right, and boom. And he'd shake and bake the basketball players right out of their shoes. That's basically what this did. It undercut, knocks you out, and then whammo, it's off to the races and you're out of the stock. So there is no real reset here. So this would be one that I probably would just have to miss, unfortunately.
Also, quick note, guys, for anybody who is submitting individual ticker symbols, we'll have the ability to do that on Monday during the live trading day. That's when Mark will have his trading charts all set up that he can do that. This is really more from the workbook curriculum that
Right.
are better questions to be asked for today. With that, question is asking, I think got like 3 different places questions are coming in at me. Does Mark methodology provide the same results when used for swing trading as compared to day trading, particularly any preference rather on a 1 minute or a 5 minute chart is the question.
So is that a question for you or for me?
Exactly. I can attest
Bob
that it
did a lot of day trading. Yeah, he did a lot of day trading. He played gaps and a bunch of other things too that are better suited, or suited for day trading. I'm not really. I've never been a fan of gaps and some of the day trading techniques, except using these same techniques with day trading. And I certainly could day trade with these techniques and get very good results. What I would warn, if you remember, I used to always say, stay away from the
Get off the
1
1 minute.
Yeah,
Too
anything
much
less
noise.
anything less than a 5 minute, I would stay away from. It's just too much noise. And so
if you value your health, if you don't care,
that's right.
you want a heart
Yeah.
attack every day, play the
Yeah.
1 minute charts.
Yeah, if you really want to be incredibly active, but I would stay away from anything less than a 5 minute chart. That would be, the 5 minute or greater for intraday. But I would also, I mean, even if I'm making a short term trade, I trade off the dailies. So that's the way I do it.
That's probably the biggest golden nugget that I will share as well, because I did have a much smaller time frame when I came to learn Mark's methodology. And having the bigger time frame provide the confirmation, for lack of a better word, or the bigger picture, the perspective that Mark always talks about, having that is what gets you out of or prevents you getting into trouble. A lot of times it can happen on any chart. In a 5 minute chart, you could probably find 1,000 opportunities to trade. But if you focus on having the bigger time frame in conjunction with and congruent with your smaller time frames, that's where it really is effective. Andrew, just asking on the breakouts. I know you talked a bit about this, but he's asking to confirm you would be buying immediately on the price breakout, regardless if the volume is showing a lot or not a lot at that moment in time.
If it's like no volume at all, I might pause or hesitate. Mark, how would you handle that? I mean, obviously, we can extrapolate the volume, but my answer is I'm not requiring the volume to be a certain volume. I will look at, I'm watching the stock, I'm watching the way it's trading, and I can get a feel for it if volume's coming in as it's moving, certainly. But, again, it could be in the morning at 9:45 in the morning. Mark, how do you handle that?
Same way. I actually don't over emphasize the intraday volume stuff. I will say, maybe anecdotally, it does seem though, let's say the stock breaks out in the morning, I would actually prefer for the volume, rather than just to be like a giant burst and then taper off. I think sort of steady Eddie throughout the day, where you're just sort of running at maybe average or above average volume, seems to be better than, if there's just a bunch of volume right where you're buying, often it means there's a lot of retail eyes watching that same spot. But again, that's anecdotal. It's not gonna get me out of a trade early, and I'm certainly, not gonna sell if I go, well, there's no volume coming in.
Yeah. And I would caution to be very careful about getting cute and start trying to overanalyze it. When the stock starts moving through the pivot point and it's coming off of a really tight, perfect setup, start buying the stock. And you can even buy just, a little bit of it. Maybe you start buying, and if it ticks up a bit more, you give it 10 or 20 cents, it starts moving up, you buy a little more, and within the range, within the acceptable range, like I said, 1 or 2%. But if you get too cute, you're going to be missing stocks. You're going to be missing the better ones too, because the best stocks just come out and they take off. And sometimes it's not on real huge volume. And while you're calculating the volume, the stock's gone and you're missing it.
Try to keep it as simple as it can be, guys. Don't complicate it and make it harder for yourself. Question is being asked to Mark Ritchie. What was the hardest MTP concept for you to grasp, and why do you think that was the case?
That's a good question.
That's a good question. I think probably the one thing I remember being very different the first time was this concept of when volatility is wider, get tighter. Just because almost everything you read everywhere says, widen your stops or use ATR. And it only took me, I don't know, maybe a few minutes to a few days to sort of internalize it and think about, well, wait a second, and the way Mark put it is, I don't want to let that volatility grab a hold of me. So why in the world would I widen? I'm either going to tighten and play smaller and play less. So that would definitely be, one that was a little bit of a challenge to the way I was thinking.
I'll draw you a little diagram here real quick and show you something. All right, let's just say that we're creating asymmetric leverage, right? So this is our potential upside, hypothetically, whatever you want to call it. This is our downside. This is our stop. Okay, so now the stock has got volatility, right? It's wider volatility. So you widen, you give it more room. Well, you're going in the opposite direction. You want to create asymmetric leverage. Well, if I go this way, look at that. I just created more R's. So that's the direction you want to go in. Now, the volatility whipping back and forth is going to produce more losses. You're going to be stopped out more often. That's what's going to happen. So you've got to make up for that. Now, if you go the opposite way, you can say, well, I'm making up for it. I'm giving it more room. So less of them are going to stop me out. Yes. But what about when the bunches come? What about when they don't come back and they don't hold and you get a long string of stocks that just keep stopping you out? Well, now you've got all these bigger losses and now you've dug yourself into a hole. So the whole idea is to create that asymmetric leverage and that's why I say always improve your worst case scenario. You're looking to go this way, not this way. And the more volatile it is, the more risky it is. So the less risk you have to take. If you take more risk, it's like boxing with a boxer, and your strategy is to jab, stick, and move. And he's a slugger. But now you say, I'm gonna go in there and slug it out with him. If you're not a slugger though, and what happens? You get knocked out because now you're letting the slugger dictate your pace. You can't let the market dictate your pace that way when it comes to risk. You've got to make your odds. That's off the top of my head, that's the best explanation I can come up with.
Good. Question being asked about if there is a percentage of a drop or a correction within a stage 2 uptrend that would be too deep for you to consider as a VCP. So what is the maximum percentage of correction that we're willing to trade?
So if the correction again, it's relative. If the correction in the say, you're looking at a big base, like a big cup with handle, big cheat area, the depth is going to be related to a few things. First of all, what did the market do? All right, if the market's pulled back 2% and the stocks fell during that same time, the stock's down 60, that's a problem. That tells you right there something's wrong. That stock is not in good shape, serious underperformance. So that would be the first thing. Now, if the whole market, you're in a massive bear market, secular bear market, then yeah, you might have a lot of stocks that are down 40, 50%. But now what does that say? A lot of supply, going to take more time to work through that. So now the bases have to be larger. And that's why the size of the bases are going to be a reflection of the overall environment. You're in a bull market with shorter term pullback, shallower pullbacks, you're going to get smaller bases. You're in a bear market with real deep bear market, you're going to get larger bases and deeper bases. So then you would require, when you get those real deep cups, if you will, you're going to require more iterations, more contractions, more time to go through that process. But still, it has to culminate, no matter what, it starts to culminate on that right side to a single digit pivot. So your question is, what's the cutoff? Well, generally, my cutoff has been, in David Ryan's too, that we've been asked this a million times. Once it gets above 50%, it really goes it's like exponential. And over 50% just gets, every 5 or 10% is just exponentially worse. 60%, I generally, I will not play those. 70, 80, they're completely off the table. 50, maybe, if it's a large base and we've got a lot of stocks that are down and it's a bear market. But generally speaking, you want to be, 40% or less. The better ones are going to be 15 to 40%, somewhere in that range. But it's a function of the market.
Okay. On page 368, 370, just a few pages before. Question is being asked, where do you know of any software that provides the historical PE ratio in the bottom of the chart other than bigcharts.com? Is that all available on market?
I don't even really worry about this much. So this is really something that I do very rarely. If I was in a position that I had for a long period of time and it was made a big move and it started getting extended from a late stage base, I might take a peek at this and say, where was the PE when it started its move and where is it now? If I wanted to sort of gauge how late stage it was, but it would have to have these other elements. So I don't know. My answer is I don't know. I don't know what other software would do that.
Okay. In general,
this is more for illustrative purposes than anything.
No problem. A few questions on earnings announcements. In general, do you avoid entering a stock just before earnings? What are your rules on stocks near earnings dates? And then to follow up is, do you ever buy before an earnings announcement on the anticipation of a good earnings event?
Sure. Sometimes I'll buy the same day of that the earnings are coming out at the end of the day, just to see if it can run up on the pre-earnings and I can get a cushion going in there. So if it runs up, 8 or 10% a couple of days ahead of time, great. Then I can go through the earnings.
So just to be clear, because it kind of sounded like you answered also the follow-up, do you ever buy before an earnings announcement and with the intention to hold through the earnings announcement, regardless of your result beforehand? Sorry. I may not be asking it clearly. He wants to know if you're buying a stock and holding it through earnings, regardless of what kind of risk profit you may have, just because you're anticipating it's a good announcement coming.
I'll answer that and say absolutely not. If he's saying, am I just going to buy, ignore the price action because I think the stock's going to have good earnings? No, that's basically like taking your risk management plan and blowing it up. And the biggest rule I have for earnings, period, is never hold a big position into earnings without a cushion. Big is relative, but meaning I'm not going to allow a sort of gap risk, event risk to do me serious harm.
Yeah, exactly.
I'm still not understanding completely. I think I thought he's asking, am I going to buy?
Would you hold it through an earnings? Would you hold it through earnings regardless of a profit cushion or not, because you think they're going to come out with good earnings?
Yeah, sometimes. I just did that with BJ and it was wrong.
Yeah.
But normally that will be with a smaller position. I'll position size accordingly. And it might be either I've already had profits in my portfolio, maybe not in the stock, but I have profits and things have been running well. If they haven't been running well, then I might do it in a higher volume, lower vol stock. I'll check implied volatility, see what that volatility is, and position size. Maybe I'll, if I take now I'm taking microscopic positions, so I can do that. And that's what I've been recommending, right, in this environment, to take very, very small positions. So like Mark said, somehow I'm going to have to offset the risk. I'm going to have to mitigate the risk. So if I would not go in with a big position with no cushion overnight, taking overnight risk, no, I would never do that.
And I think it's a good point, Mark, because I don't think it's something we've said, but you do look at top competitors, the leaders in perhaps that industry. You see how those earnings results were received by the market as well at times to get some indication of how the market conditions are.
Yeah, but again, even like something like First Solar and Enphase right now, they sort of decoupled. Enphase didn't act as well; it was acting well, and then First Solar actually did pretty well, on the earnings and the post earnings. So again, that's not going to mean if one company does well, the other one is. But yeah, if again, if the whole group's rip roaring and it's just a great, you're getting just great results in the market. There's periods where this is getting into where it's making making decisions that are very subjective. I've been doing this a long time, and even Mark, we get a good, they call it ticker sense or feel, but you have to be real careful about not being mechanical in the beginning and using any type of your gut or emotion or any type of non linear decisions, because you got to get that stuff down first. So I would caution you against, having favorites and saying, "Oh, I think this one's going to do well, so I'm going to hold it." And then you set yourself up for big risk and you get torpedoed. And now you're in big trouble.
Question referencing the PE ratio not being a good indicator for high growth stocks. Do you ever use price to sales ratio instead, especially for those companies that don't have profits?
I don't. I haven't seen anything that it's valuable over the long term or for timing. You can have stocks that have super high price to sales ratios and they go on to make meteoric rises, gains. The thing you have to realize is when you get the high price to sales ratio, the high P ratios, any of those metrics, that the stock is priced for performance. There's a high expectation. That's what that means. So these are stocks that very often turn into the best shorts once their life cycle's over. I mean, Facebook's a perfect example. I mean, here and many of these stocks that were the big secular leaders. Again, if you're up, just think about it. If you're up 8,000%, 10,000% in a stock, and you happen to get Facebook or Amazon or whatever, one of these super secular mega cap winners that turn into the big leaders, and you got it dead right, but now you held it down 75%. If you were up 10,000%, you just gave back 7,500%. So again, it's just a matter of what the stock is priced for as far as expectation, and that's what it's going to tell you more than more than I'm going to use it. I'm going to avoid a stock that has a high price sales ratio.
Quick question on that note, since you just did bring up shorting. What is your shorting criteria? Technicals or fundamental related?
Yeah, I'm not going to get into shorting. It's enough just to teach how to trade on the long side. I think you should stay away from shorting, especially if you're new. I wouldn't go anywhere near shorting for years if you can't be profitable on the long side, you have no business going anywhere near shorting. That's number one. And I'll let you talk about that too, Mark. But here's the main reason why I say about shorting is that it's just unnecessary. I've found it to be unnecessary. I've been trading for 40 years. And over that 40 years, 99.9% of my wealth has been made on the long side. All right. And I've been through every type of period. I've been through 9 bear markets, some of the worst bear markets and crashes in history. And I never had to short to make my return. So I just have found it not to be necessary. In the current environment, with the way we've got social media now and with the Reddit phenomenon and all that, the last thing in the world I want to do is hold shorts overnight to wake up the next day to find out, it became a meme stock and overnight it's going to gap up 500% on me. There's just a lot of risk in shorting for a number of reasons. But Mark, in all your trading, and the big returns that you've made and over the years, I mean, again, what percent? I think I asked you this before. I can't remember, but what percentage is from shorting?
Yeah, almost none. And the funny thing is I do the least amount of shorting that I've ever done. I early on used to, I remember Mark would say this type of thing, and I'd still short here and there. And then, again, evaluating my own numbers and results, you just realize this isn't really, I think the way Mark puts it, sometimes the reward to aggravation level is just not it's not there for me. I would just add too, I think for folks who want to just keep, trading, it's usually indicative of the fact that you're not trading to make money. If you feel like when Mark says, hey, I've made millions and millions of dollars trading and I haven't made hardly any of it on the short side. If you're going to ignore that and just go, I want to do it anyway, that tells me more about what's ultimately motivating your desire to trade.
Yeah, I do short the ETFs because again, that overnight risk of a stock gapping big against me is not there, or certainly it's mitigated. So I will short the SPY. I'll short maybe the Qs, the IWM. I will short those from time to time when I feel like the market's topped, and usually that decision is led by what's happening in the individual stocks, and then I start seeing distribution in the averages. I have from time to time, I will short those, but again, they just doesn't account for much of my return. I was actually short on 9/11. There was a very mixed emotions. I was about to make one of the biggest scores of my entire career, probably the biggest score of my entire career, being short. But again, we had clients and friends that died in the World Trade Center. My assistant was actually he was coming to work. I was in New York City at the time. He was coming to work, and he was in the World Trade Center just a few minutes before it collapsed, and left there and came to work. And he was so shooken up that he actually quit and stopped working for me. He had such PTSD from it. So again, even with that, my point was that even with being short on 9/11, I was short on some of the crashes. I was short during many of the bear markets. Even having with the kind of accuracy that I've had and being short at these times where, was a great time to be short, it never accounted for that much. The opportunities were so much greater on the long side.
And just to point to that, the cliche of the stocks climb the stairs going up and take the elevator down. If you're not being successful with it moving at a step-by-step motion, going down very quickly, you have to be even quicker to react at times, and that's that much more of an added challenge for shorting.
And with the Reddit phenomenon, they take the elevator up now too.
Yeah, no, that's
sometimes
true.
even faster.
That's that was definitely phenomenal. Quick question, which was being asked. Getting back here to these questions on that, getting back to some of those fundamental questions. What is your experience using free cash flow growth rates as opposed to earnings? Because the person's mentioning earnings can be manipulated, but free cash flow cannot.
See, again, okay, and don't take this the wrong way. I'm not gonna, and you're not here for me to beat up on you, but this is the kind of question. This is exactly what creates a failed trader, in my opinion, because here I am, 40 years doing this. I've got one of the best track records probably in the world over that time period. Mark Ritchie has got one of the best track records probably in the world in his time period. And I'm showing you everything I do, but do you want to know about something else? And so I'm not hiding anything here. We're not hiding anything. If that was important, we would have showed you that in fundamentals. So you're not going to come up with something and I'm going to go, oh yeah, actually that's good too. I forgot to tell you about that. Or this is it. This is what we use, nothing else. So there's no hidden secrets here. We're showing you everything. There are no secrets. This is about work and skill and discipline. So my answer is no. I don't look at that at all. What I look at and what I use and what has been responsible for my success. Nobody else's. Somebody else might use stuff that completely the opposite of what I do, and they can be successful. And that I'm not saying that my strategy is the best or that my strategy that you have to do this. This is the way I do it. And I know everything about this strategy. I am a professional at what I do. I am one of the best in the world at what I do. And I created this. So I'm the inventor of this. So obviously I know it better than anybody. So I don't know anything about value, about all the other, about reading balance sheets and forensic accounting and all that. But I do know I have met thousands of traders. I've been in the business for 4 decades, and I have not seen many people that can outperform me with what I do, even armed with teams of analysts and the best forensic accountants and all this stuff. They still haven't outperformed my strategy. So I'm going to stick with what I do and what works and leave all that to everybody else. And if they can do well with it, God bless them. I wish you the best. But this is what we do. And we're giving you everything here.
See a couple questions here regarding risk management, stops and position sizing, guys. This will all be covered tomorrow. So I'm going to bypass these questions. We haven't even gotten to explain those concepts to you yet. But
Right.
There is a question mark that's asking, so talking about earnings per share, sales and margins, but we also have rules based on technicals. The question he's asking is, what does it matter what either the company does or their backstory if we're going to be following a rule or technical rules anyway?
Okay, that's a great question. Now, you could trade on pure technicals. I mean, certainly. I look at it this way. I want to bring everything into the equation if it's accretive, if it's supportive, if it's helpful, if it's going to increase probabilities. I want to bring everything into the equation if I can. Going back to the previous question about cash flow, you could put return on equity on that. You could put price to book value, price to sales ratios. In 40 years, and also O'Neill. I mean, O'Neill's before me, and prior to that, other traders that were great minds in this business. In our field, in the field that I've been in, we haven't found that stuff to be to have a correlation. Now, this is all stems from reverse factor modeling, which is not backtesting. Right. Backtesting is when you basically try everything and see what correlates. And you're going to find, I mean, if you were to take and study beetles scurrying around, if you studied them long enough, you would probably come up with a correlation to the stock market, to the wiggles of the stock market. You have the NFL indicator and all these things. And, something will eventually line up just simply by pure chance. So that's why backtesting is garbage. Factor modeling is like, let's say that you were to study Olympic athletes. I think I talked about this early on, but it's worth mentioning again. You were to study Olympic athletes. Well, I would say, okay, well, let me see these top 100 gold medalists. Did they all eat a certain diet? Is there any similarities? Oh, yeah. Well, they all eat a lot of all the weightlifters eat a lot of protein. As a matter of fact, there was a study done of Russian Olympic weightlifters, and they found that they ate 3.5 grams of protein per kilogram of body weight. That was what across the board, all these big lifters were having at least 3.5 grams of protein per kilogram of body weight. So that's great. That's something that all the champions have in common. But they have a certain training routine. Do they get a certain amount of sleep? What is in common? What do they have in common? All right. And this is the same thing when you analyze your own trades. You look at you do post analysis and you say, what is happening here? What does all my trades have in common? What's the common denominator? And that's how we got to this. That's the starting point. Then slap on 40 years of doing it in real life and trading tens of thousands of trades and looking at millions of charts and working with thousands of traders. And now I corroborated all that. That has been proven to me with real life, with real money. And now it's been duplicated, not just with Mark Ritchie. Many times we have tons of people that have done really well with this strategy. And now Mark Ritchie using the same strategy. So this is a timeless approach. I know I'm going on a tangent here, but probably don't even got off the original question. Mark, I'll hand it off to you.
Bring it back to the question.
Yeah. What was the question again?
Basically, it was since we have a set of technical rules that we're following,
right.
what difference does it make to know any of the fundamentals? Or
Well, I would go back to
and I'll circle back to that too, but go ahead, Mark.
No, I would go back to the 99% club, or some of the biggest winners in history did have some of these fundamental things on the table, and they come from some of these specific groups. So why not play in that sandbox as well would be my thinking or my answer. But to Mark's point, if you just master spotting these low risk entry points and VCPs in proper context, by the way, because the pivots set up everywhere, but I see people showing, hey, is this a good pivot? And the stock's in a stage 4 and it's coming off a low after it's been down 80%. Well, yeah, if you just look at it on the narrowest right-hand side and don't take into account any of the rest of the chart, if you master just the technicals, you can absolutely trade and make a living, doing those. No question about it, in my opinion, because that's the idea, of this supply and demand is a timeless concept. And all we're doing is looking for that supply stop coming to market where it only takes a little bit of incremental demand to move the stock. But, why not put everything in your corner would be my answer.
Okay, so I'm going to give you a straightforward answer now. And thank you, Mark, for bringing us back to earth. So again, if you go back and you look at what I talked about, the 95% club, this was sort of the first quantitative model, if you will, or factors that I put together when I first started doing this back in the 80s. And you see 95% of the big winners have earnings acceleration, right? 95% have a new product service. This is certainly going towards CanSlim, right? So, and that's what O'Neill found. He factor modeled and found that these common characteristics, right? So why not? What I found is that when you have probabilities, 1 + 1 doesn't equal 2. Okay, and 1 + 1 + 1 doesn't equal 3. As you add probabilities, as you add supporting factors, it's exponential or it's multiplication. 1 + 1 + 1 could equal 9, when it comes to probability. So I call it probability stacking. And it even comes down to time frame stacking. Like I try to stack all the probabilities in my favor, and then I want a time frame stack where I've got all the time frames in my favor. So I've got the long-term trend, the intermediate. Why do we wait until the stock makes the turn and goes through the low cheat and turns back up? Because I want the long-term trend, the intermediate trend, and the short-term trend all going in my direction. That increases the probability that the stock's going to move in my direction quickly. So all this is about putting as many probabilities as you can together without putting things in there that are unnecessary. And that's where, when you start getting into all this other data, it could be, you can start clouding your model where now you're putting stuff in that's diluting it. That's why we brought it down to what moves these are the things that move stocks. Now, the other thing is, to answer your question, it also depends. It depends on the situation. If you want to trade purely technical, fine, you can do that, certainly. But I think you're missing out on some important information that can lead you to certain situations. For instance, biotechs, no earnings, growth stocks. Again, if you've got 100% earnings growth, and like I showed you during the fundamental section, this is a situation that can't be priced very well. It's growing too fast. So by having that type of situation, that's a stock that can go and make a huge move because you just can't price it. It can't be priced efficiently. Knowing that might be a stock that I'm now going to play for a much bigger move as those earnings are coming, as long as the fundamentals agree. So having the fundamentals and the price and all that is going to not only increase your chances, but Mark, you even said that you went back and found that your bigger winners almost always have the fundamentals too, that just purely by, and I'm going to tell you right now, you certainly, if you traded this long enough and you were to trade for the larger moves, I'm talking about not short-term moves, but, decent bull market cycle moves, the earnings are definitely going to help for the bigger movers. To have the earnings, the sales on the table absolutely are going to increase your probabilities and increase the magnitude of the move that you can get from a stock. So why not use it all, as long as it's accretive, as long as it actually helps the probabilities.
Well, and I'll just add, the last question, you talked about the idea of reverse factor modeling. That's essentially what I did with my own trading. I didn't back test and cherry pick stuff. I just sort of reverse factor model and said, what do all the best winners have in common? And lo and behold, most of them hit smack dab right on this page. So this is, again, when I keep getting the question, why aren't you trading these bank stocks when they set it up? Why aren't you trading these these oil and commodity names. It's like, well, because they're not on this list. And what, I want to dance with the girl that brought me to the dance, or I brought to the dance, depending on how you think about it. And that's precisely why I'm more convinced than ever that, this is a timeless idea. And the sooner you accept that, I think that the better your results are going to be.
And I would say that the general rule of thumb is the shorter the time frame, the less you are going to be reliant on fundamentals. The longer the time frame, the more you would want to have the fundamentals in there. If you're, again, if you're scalping for 2 or 3 day moves, it doesn't matter nearly as much, if at all.
Yeah.
Yeah.
Question on squats and reversals, Mark. If the squat occurred on high volume, extremely high volume, is there anything that would cause you to get out of the stock before it triggered the stop loss level? As an example, super big volume on a reversal.
Yeah, I'm going to let Mark answer this too and see what his thoughts on it. But I think he's going to tell you basically the same thing. But so this is something that has to be measured, and there's not really a formula. But yes, if the range, like I think I said this before when we talked about squats, if the range was 10% up for the day, and it closes on the low, and now it has this huge amount of price to get through, and you're on huge volume, I'd probably reduce, if not sell. So it depends on how much it reverses and the tape action a bit. So that's a judgment call. But generally these reversals, these squats, and they pull back from 2, 3, 4, maybe 5% ranges, and they come off 2 or 3% off their highs, and it's not this real big, magnitude. And again, I think, what was the example we had when we were doing the squats? Hold on. It was why what page was that on, Bob, with the squats and the reversals section?
Why is 270?
270? Hold on, I want to show you something. Yeah, so here, this is a pretty big reversal here. Okay, that might have, I didn't trade this here, but that might have got me to sell it, or to, and again, now, is it an outside day? That's another thing I'm going to look at. This wasn't an outside day, but it was very close to it, or it might have just undercut. And did it engulf the whole pivot? So now let's just say this, was way up here and came out to 1550 and comes all the way back down, closes near the low, and takes out the low in the previous pivot. That's pretty ominous. That's got such a giant range to get through. I'd probably sell the stock at that point, but it's a judgment call. It's definitely a judgment call. Maybe this is something that I need to work on to quantify more, to be able to teach this of, looking maybe through my eyes. And there's a way to quantify this a bit more. I haven't done that yet, I guess. How about you, Mark, as far as any general rules of thumb on that?
Sure. Yeah.
Good question. It's a very good question.
It's a great question. And something I've sort of coined the power squat. The really big squat is the one that tends to scare me, or get me to, cut the position. This would be the borderline one, because I'm just looking at the math here. This looks like it might have pulled back about 5%. I would say anything, mid-single digits, I'd give it the benefit of the doubt. Again, assuming it doesn't engulf the entire pivot, to Mark's point. But if you're high single digits, 10%, I'm probably cutting the position, because you just basically reintroduced a whole bunch of new supply. Everybody who chased that breakout is now underwater, and it's going to take, if the stock is going to work, most likely it'll probably give you a secondary buy point, like you see here on this chart with YY. And if not, I'm willing to risk that in terms of just stepping aside, because the stock isn't really ready.
Yeah, I think Mark just hit something on the nail on the head here, which I'm going to definitely use going forward, is that it reintroduced new supply. And so that's exactly what's happening here. And that real big range, see, Mark's thinking the same way, but on a shorter term time frame within just one bar, meaning that, okay, this stock's way up here and comes down. Well, there's people that bought around that high and didn't sell. So you have trapped buyers. And that's just, again, creating the same thing all over again. And if you were to look at this, break this bar down on an intraday and look at it maybe a 5-minute chart, you'd probably see that. You'd probably see that supply where it goes up, it comes down, and now you've got that same big deep base compressed right side. You'd see that whole thing all over again. And that's probably something maybe in the future we can break down a reversal like this and then look intraday. And maybe even it's worth, Mark, maybe it's worth when we get a big reversal like that, flipping over to an intraday chart and taking a look and seeing, what it looks like on the intraday. But
the more, it's funny, the more I look at this one, because I just looked at the volume, and on that reversal it looks like that particular day was decent sized volume. So that would be precisely what looks like supply. But this is such a great example, because what do we have here? About 7-8 day, pivot reset. And this is where, even if you stepped aside, say intraday, we have a technique to get right back on board. So you don't have to widen your stop to account for that. You can just step aside. And if the stock is truly going through that process, all that supply that got reintroduced, it still gets wrung right back out here in, 6-7 days.
Right. And that's what we're seeing with the tightness on the right side of there. But general rule of thumb, I would say I would agree with Mark that I have to looking back at how I trade. Yeah. If they're like in the mid single digits to low single digits, I don't look at it as that negative. You start getting getting close to double digits, 8, 9, 10% or more, that becomes more ominous, and I'm likely to reduce or sell.
Question to Mark Ritchie is being asked, how much, if you know, of your profits over your career could you break down or from power plays versus other trading setups?
I have not done that analysis. The power play, to Mark's point before, is not sometimes we have periods where they don't set up for a long period of time, because I have gotten the question, why not just only trade power plays? Well, it's sort of like saying, if I was a carpenter, why not only use a hammer? Well, because I got all these other tools in a toolbox to help me, accomplish my goal. But, if I had to guess, I'd probably say maybe 10 to 15% or something like that, just because you don't get 300 power play setups in a year.
Right.
We're in a good market. You might get, we might get a handful of power plays, but then we get lots of other, cheats and low cheats and handles and all these other setups. So yeah, I don't really think of it that way.
Yeah, it's thematic. I'm sorry, Bob. It's thematic.
Yeah.
And there's times where you won't get any power play simply because the market is in deep correction. You're getting all low cheats. The other thing too is, like Mark said, why not just play power plays? Well, that's like saying, well, why not? Let's say we concluded that sailing is best done at 42 miles an hour winds. Well, why not just go out when the wind is 42 miles an hour? Because you probably have pretty good sailing at 38 miles an hour too, and maybe even less. So it's you don't have to be that of a stickler to be trading only in the absolute best setups, because the best setup in another environment might be coming from a cheat, or good enough to still get you to these are all good enough, let's just put it that way. And there's different tools and different tactics as well as different environments. And that's why when you use the low cheat, the handle, the pullback buys within the low cheat, the handle, the primary base, looking at initial primary bases and power plays, nothing can really get by you. Like, we've created this net over my 40 years. I've created a net to where not much is going to get by me. I'm going to have to see the stock at some point. If a stock's going to make a big move, I may not get it at the lowest price. I may not get it off the first base, but I'm usually going to get it somewhere within the first couple bases, and I'm going to get it off the low cheat, the handle, a power play, somewhere off the IPO after it's issued. I've got these techniques and these tools where it's close enough where I'm going to get the meat, and I'm going to get in there, early enough. Like I said, like third floor, fourth floor, fifth floor, riding to the 30th or 40th. It doesn't really matter if I get on the third, the fifth, or the 11th, if I'm going to the 50th.
I just checked just for interest's sake here, because I have my again, I track my trades. I got the stuff in front of me. So in the last 10 years, I've traded about 180 power plays. So
Wow.
that on average, that's about 18 a year, but they don't distribute that way. And I think this year I've traded like maybe 3. So, it's very chunky, and I've done a lot more than 180 trades in the last, decade. So that just sort of puts things in perspective.
So Bob, I just want to say, and we're not going to show our Minervini private access platform, but we do have a trading logger software where you can log your trades, and we've added something recently where, Bob, we can code it, right, and
Yep.
then look back that way. So a real, and this is something, again, you don't have to use our service. You can do this yourself. As Mark has noted, which stocks are power plays. He very quickly obviously went to a spreadsheet and saw which stocks were power plays and can determine that. So what we have is that you can code when you put your trade in, you code what it is, but then you can go back and look at the stats, the average gain, average loss, and even a bell curve and all that of either your whole portfolio, or you can break it down by whatever code you assigned. So if you want to say, hey, these are trades that I'm scared to death when I bought them, and these are trades that I feel really confident, and these are power plays, and these are low cheats. Then you go back and you can slice and dice the numbers and see exactly what the bell curve is of that set that you and that's something, again, like you probably take a bit for you to program it in a spreadsheet, but that's something that we have as a tool, and you can use yourself too, if you want to.
Specifically, just to that effect of what setup were you buying for each trade, you can instantly just be able to generate the results and see your performance on those results. And so it's a very very sophisticated software.
But you may want to track that yourself, just with a journal. In your journal, just write down when you make a trade, what exactly it is, and your feelings behind it. You could even go back and again, I used to track when I first started. I keep a journal, and I would put, if I have put like smiley face, sad face, I had like these little symbols and acronyms, and then I went back and I took a look at, like when I'm confident, is that good, or should I fade myself? Like when you first start doing this, when you're scared to death is usually when you should buy, and when you're happy as can be is when you should sell. But then as I tracked that, all of a sudden it flipped. Like I started getting confident, and when I was feeling happy faces, there was good trading ahead, and when I was feeling bad, and nervous about the market tanked. So that's when I realized, when I became more professional, I became a pro, that my gut started being right. So I tracked all this early on through a journal. Back then when I first started, all we had was pad and pen. So you don't need sophisticated software to follow this stuff.
Go to page 359, Mark, but I have a question before we go ask that one. Question being is, how much influences the market to your trading? So you obviously had your sell signal triggered on November 22nd in 2021, a year, almost literally to the day, a year ago. So how much would that influence your trading activity, and or in what way would it influence your trading activity?
Well, I would say the trading activity influenced that sell decision. So it's just the opposite. The sell signal didn't come before my trading activity. The sell signal was a result of the trading activity. So when we simply get buys and sells based on how the stocks are acting, and the underlying real market is performing. So again, when going back to that sell signal, there was like under 40% of stocks above their 200-day on the NASDAQ, when the NASDAQ was hitting an all-time high. And I had never seen in my entire career, or any study going back prior to my career, that the markets could survive that usually rolled into a correction or a bear market. And then the fact that all the stocks were failing was enough confirmation that to put that sell signal on. So yeah, it's not, again, it's not the cause, it's the effect.
Okay, on 359, question first off was being asked by one member, where would you have been entering this trade? He's just not seeing a setup entry point.
Well, you're not seeing a setup here. If you're not seeing a setup here, oof, I don't know. I mean, I didn't do my job here over the last several days. This is about as clear of a setup as you could possibly get. It wasn't where I would have been buying it. I bought it. I bought Amazon on this day right here that it squatted. And that was as perfect of a setup as you can possibly get. I mean, here's your IPO. You go through a big cup with handle. You go through iterations. You even had a low cheat right here, which at that particular time I was not buying from low cheats. I was buying from cheats. Low cheats. I didn't start low cheats until after the 2000 bear market, believe it or not. I was just looking for, I was only buying in the middle third or upper third of the base. It wasn't until I observed the lower third for like 10 or 15 years that it was working, that I even started having confidence to play it. But I bought right here and it squatted. And then the next day you had the reversal recovery. The next day came out, squatted again. You had another reversal recovery. But that's where I bought Amazon the very first time.
Yeah, and that's the next question from Gustavo, who's asking, how did you, what would be your selling plan with the squats and the recoveries with such a wide price action at that time?
I don't know what that means. What would
I'm
be
not
my
sure
selling
we've
plan?
not
My selling
pressed on
plan
that.
would be to sell it when they hit my stop. This
So the
didn't
volatility
there's no volatility here. There's no volatility here at all. This is all upside. This is all alpha. There's virtually no volatility at all. This stock moved out, had a little pullback squat. The very next day took off. Look, guys, you gotta study what these terms mean. Volatility requires price back and forth in two directions. When you're going straight up, if a stock went, let's say a $10 stock gapped up tomorrow to 11, and the next day it gapped up and it didn't trade, it just gapped up, 11 stopped, then it gapped up to 13, and the next day it gapped up to 20, and the next day it gapped up to 100. What would the volatility be? Zero, because it's all in one direction. That's called alpha. Okay, that's what you want. There is very little volatility here, these pullbacks. And then look at the tennis ball action. You get the squat and then bang. Then you get another squat. It actually tries to follow through, but it squats and then bigger bang. Like, this is telling you that the short-term selling is being completely absorbed and then some. And you're getting closes right on the highs, right near the high here, right on the high. So this is acting as perfect as you can get post breakout here, post the squat. So again, yeah, not much volatility there.
Question, Mark, you have on multiple different charts the RS, the index that is being compared to with the stock itself. Sometimes you're showing the S&P 500, sometimes you're showing the NASDAQ. How would one know which index you should be comparing that stock to?
I'm almost always showing the S&P 500. You can, in MarketSmith, I know you can choose the line now. That wasn't always that way, but you can choose. I would use the S&P 500. You might want to, there's times where I'm, just for illustration purposes, if I'm in a NASDAQ stock, I'll show it against the NASDAQ index, just simply, and especially if it's maybe a real NASDAQ type name, or a name that's highly weighted in the NASDAQ. I essentially use the S&P 500. That's what I use as the default.
Okay. And also, if you can quickly explain the difference between the RS rating and the relative strength line on MarketSmith.
Okay, well, sure. These are probably questions that we should ask Scott St. Clair, who's from MarketSmith, but I certainly can give you the correct answer. But the RS ranking is a ranking where they're taking all the stocks in the universe, in the database, which I think in MarketSmith is about 9,000, and they rank them against each other, and then take the strongest and give it a 99 and rank them on percentile levels down from 1 to 99. So that number is not ranking against the market index. It's ranking the stock against all the other stocks in the market. And it's based on a 12-month RS, but it's weighted 40% of it is in the most recent 3 months, and the previous 3 quarters prior to that are 60%. So it's 20, 20, 20, 40 for the 4 quarters. And then the RS line is comparing it to the index. So in the case where I said where it would be the S&P 500, or you can compare it to whatever index. If you just divide it, the stock by whatever and the underlying index or another stock, and then plot it that line, that would give you the relative strength line.
Okay. Question about rules for one's trading performance. Is there a stop of your own trading when things are not working in the market and you're not trading well and the market doesn't seem to be working in our favor? Should we stop for 1 month or more? What would be your rules for your own trading stop?
Again, I wish there was a hard and fast rule, but I think, that's something that is going to be individualized depending on, what the definition of, the trading's not going well, or it's, you're in trouble. I mean, for me, for some people, I have friends that they go, oh yeah, I own Bitcoin, I'm down 60%. I'm not worried. I'd be jumping out of a window, but maybe, they don't own enough to, for it to be put that much pressure on them. But, for me, if I'm down high single digits in my account, it's like code red. This is like a massive emergency because I'm looking at a double-digit loss. So and so I can't say. That really depends on on the individual. But Mark, do you have any general rule at all? And after X amount of trades, that you just sort of say, okay, I'm just going to sit back and just watch and just stop playing?
Yeah, well, as a general rule, like I don't have I think some people would call this like, do you give yourself a timeout, or where
Yeah.
you just kind of get out? I don't, I found for me the best thing to do is continue doing the work, but just trade, almost at meaningless size, because it just keeps you engaged and your finger on the pulse so that you're ready when things, do potentially turn. But, similar, bigger mid-single digits, nearing double digits for sure. I'm basically going to take the approach that I'm going to allow it. It's going to have to take a million little losses to continue to knock me further in the hole. So the bigger it gets, the more I go into the turtle position.
Yeah, I kind of by default too. I found that here's sort of my tactic, I guess, that I use. Once I start feeling pressure, and I'll usually give it, couple trades, couple iterations. Maybe there's some setups, couple breakout, they don't work. All right, we'll try a couple more. All right, now I'm getting no traction. I will at the very minimum cut my position sizing in half. All right, so a couple now, and then I will require less evidence. So if it was 5 trades, all right, for me to cut in half, well, now I might put 2 more on, and then I cut it in half again. And if that doesn't work, 1 more, and I cut it in half again. And if you do that, usually what happens is by the time you cut it in half 2 times, you're at very negligible levels. You're down to quarter positions at the absolute biggest, because even if you have the full position, you would go to half the quarter. But in most cases, you're even smaller than that. So as Mark is saying, as you're cutting back, you're getting to negligible positions. And then it doesn't matter as much as sort of just keeping your finger on the pulse. So I get to these places more by default, by incrementally bending with the market and bending with my results. And then if, let's say, the opposite, I do a couple of trades, 2, 3 trades, they work, I'll add a couple more. I might step the exposure up a bit. If I get a few more, now I bump it up. I might double my position size or triple my position size. If those start working, bang, I get super aggressive, and I'll start financing the risk. So in either direction, that's how I just get there sort of automatically. And that's going to be more, skill related and experience related.
All right. Question about IPOs. If you can share if there's a minimum stock price that you would trade an IPO quickly.
Yeah, well, you see, if you start getting to IPOs that are like single digits, they're $6, they're generally the low quality. They couldn't get a really good underwriter, and they're definitely suspect. So, do I have a cutoff? Generally speaking, my cutoff is $10. I want to see the stocks, $12 or more. And the power plays, I'll sometimes go with the lower price stocks, like the $10 or $12. When I get into the single digits, then it gets, then I really am going to be careful. down to about $6, and then below $6, I start getting to $4 or $5 below $2 stocks. Then I'm completely staying away from those 99.9% of the time. So that's sort of the ranges. I don't know, Mark, do you have a cutoff as far as, I know we've played some $6 stocks and $8 stocks, but it's rare.
Yeah. Was it related to IPOs though? Because I can't think of too many, IPO bases specifically.
Yeah, I'm talking in general, but IPOs
Right, yeah.
very rarely come out at less than $10 or $12 or $15.
Yeah, that's almost like a self-reinforcing deal with IPOs. But then generally, I would say, yeah, the cheaper. I used to trade, especially when my account was smaller. I used to trade some of the lower price stuff, but I just wanted to be that much more crisp. And then generally, I was that much quicker with them. They're more volatile, but you can trade them. But I want things to look, the lower price, the more stringent I want to be in the criteria even. So we'll trade some $5 to $10 ones, but they're going to look pretty good or almost perfect in my view.
Yeah, but just think about it. If Mark Ritchie and I have a tough time, getting on a position, we're worried about getting on a position because it's $6. I got to buy, let's say, $1 million worth of stock. Imagine how difficult that is for an institution. So again, this is why, I'd much rather trade a stock. And I love that stocks don't split and they're trading at $1,000 a share. The amateur investor, he's like, oh, I can't buy much of that. It doesn't matter. It's just a dollar amount, whether you buy, but it does matter if you're got to buy a lot of size, a lot of shares, and that share volume moves the stock in the short term. It will create that intraday volatility where you'll get a bad fill, or you can get hosed on the stock.
Also on IPOs, after an IPO, there's a lockup period, usually 6 months later, which is a big supply potential coming to market. Do you ever take that into consideration?
I do take into consideration, I try to know, where those zones are. And there's a couple of things I take into consideration with IPOs. One is lockup period. What I try to do is, again, I'm going back to differential disclosure. How is that period being handled in the market? Like, how's the stock behaving around that time? Okay, so this lockup period is going to end on this date. Okay, well, that's an important date to watch to see how that supply is being absorbed or not. So the other thing too is to be cognizant that I've seen in recent years, or maybe the last decade or so, is that it seems like after an IPO, sort of the general tactic for a lot of these companies is once it doubles or triples, they start coming out with the secondaries and they start sitting on the stock. So I don't know, as far as those two things are concerned, Mark, how about you? Any observation of that or tactics, around those events?
Sorry, which event specifically though?
Well, I'm talking about where the question is about IPOs in the lockup period. What I'm saying is, watching it close to around the lockup period, seeing how it acts, but also, noticing that there are a lot of secondaries come out once the stock moves up, and if it doubles or triples, it's like, the IPO is doing well, and it's just like in anything, there's buyers, people are happy, and they can issue more stock when they have.
Right. Yeah, I was going to say,
I watch around those times, see how the stock handles that.
Yeah, I have to be honest, the lockup period is not something I actually watch or have studied a whole lot. But in terms of the secondaries, normally if the stock is moving well, and it's a secondary, I've found that, I tend to tighten up because one of two, like assuming that the trade is working and then the stock issues a secondary. And that does seem to have been a theme prior to this most recent peak. Maybe the prior 2 or 3, 4 years, you get a stock moving and then the company issues a secondary. That seems to take the starch out of the move sometimes. So, but if it doesn't, I don't want to just sell it usually. I usually want to watch a little bit, because if it doesn't and that supply just gets gobbled right up, it can tell you that there's still demand there for that stock. So, but yeah, it does seem like, especially in some of the situations, again, where there's not maybe as clear fundamentals. And think about it. Why is the company issuing a lot more shares? If there's really good earnings on the table, they're often not doing that. If it's a company that's just trading on, maybe sales or that type of a thing. So this is where, again, if it's a trade and it's going well and they issue a secondary, often I'm moving my stop up and then, looking to, choke that. I don't like to choke any trade off, but not hang around for an extended period of time, because that often creates a new base, and that's something then I'll just wait for it to set back up and jump back in.
I think you have to be very careful of, having a hard, fast rule, and it would not serve you to, have rules based on lockup periods and secondaries to automatically sell a stock, but more to watch the price action around those times and see if things make sense, like the differential exposure, differential disclosure. I'm sorry, where comparing, the news, the event to how the stock acts tells you how that's being absorbed and if it makes sense. Just like a stock comes out with a great earnings report and it gets clobbered, it's down 20%. Well, that's not a great earnings report. It beat expectations. It's up 240%. Looks great on the surface, but it's not, because the stock, how it's responding, is telling you that Wall Street or then the institutions, that's not what they were looking for. And that's more important than what's actually reported. I use this same approach with this.
And I think we talked about part of the question here with regard to power plays. Same kind of question. Is there a stock minimum price for power plays? But the follow-up is, how do you screen for power plays? And then do you take fundamentals into account for power plays? Which I guess you can answer all three.
Yeah, well, of course, we would take the fundamentals in account. You just got to go back to, your workbook of what I talked about, categories and catalysts. I want to first define what kind of company it is. What we're dealing with here. What kind of company? What do they do? It's a drug company. Okay, they have got no earnings, sales, but they've got this great drug in the pipeline, just, past phase 2 FDA approval. This is something that, it could be is the catalyst for the stock, and it's not trading on earnings. So that's the first thing. But with power plays, how we would screen for them is we'd screen for them just like we'd screen for any other stock. The only difference is that this is why in MarketSmith we put the 1 month trend template, because sometimes they will set up, and you won't need the 5 months where the stage 2 is in that uptrend for a confirmed 5-month period, where they could be we found that they can take off just from a 1 month where you've got the 200 days in an uptrend for just a month. So that's where sort of the caveat to the stage 2, the confirmed stage 2 uptrend, we'll look for power plays. And like I said before, this is a screen that David Ryan says he loves and he runs all the time. My 1 month, he runs the 5 month and the 1 month, but he says he always runs the 1 month to see the stocks that are turning up first, and at least get sort of a heads up on them, and also look for those power plays. And we'll talk about that when we're going over MarketSmith with Scott Sinclair.
Also, is there a way to screen for high alpha?
The alpha that that's in MarketSmith is not I would say, I shouldn't say. It's the alpha tools that I've used in the past, and I have a custom sort of formula that I'm working with right now that I used many years ago, which is a formula with standard deviation alpha that we're trying to create sort of a power ranking that we're going to offer to our own members, sort of like a relative strength ranking like IBDs, only it's going to be sort of a Minervini ranking, which is a little bit more advanced than just an RS ranking. I tend to, the way I do it is my eye is the best calculator of alpha and standard deviation. I can just look at a stock and I can tell you the stocks that are super high alpha, low standard deviation, simply about how they're trading. And I do a better job with that than a ranking. So I focus on the relative strength stocks that are, I have a cutoff, an RS cutoff, and then I just look at all those stocks, and I do, almost all my work is done manually, just like Mark's. We're looking at the charts. And screening is just to sort of give us a list of candidates, but then we're doing the work by looking at the charts. And again, once if you get to the point, if you ever get to the point where computers can do all this, it could make it ineffective, for a period of time, but then it would be effective again, because then no one would, nobody's going to use a strategy that's not effective. So that's sort of the ebb and flow that you go through. I don't think that's going to happen, first of all. And again, it would be just you'd have shakeouts, and you'd still end up culminating to the same VCP setup, because ultimately you can't hide supply demand. Supply demand is still going to, it's like gravity. you're not going to change it. You're not going to change it. You can take a rocket and burst it into space and fight gravity, but gravity is still going to be there. You're not going to change the formula of gravity, and it will still be in effect. Getting a little deep there.
All right. Question being asked if you miss coming back to the reversals and squats, which is a question we probably have had one of the most common questions we ask. If you miss the pivot breakout point because the stock moved past your 1% buy point and the stock does reverse back down and then it starts to move up higher again, either on the same day or subsequent days, will you buy on that renewed breakout of the original price action? So I had a few questions on that.
Again, I would again, these questions, I always give the exact same answer. I'm going to have to see the chart and see how that manifests itself. In this instance here, taking a look at Amazon on that reversal day. Now you see the squat, and that day still keeps it in a very tight pivot. So let's just say I didn't buy on that day, and I just noticed the stock the morning of the breakout. I would have bought the stock, if it took out the high of that pivot, and that would be the high of the pivot. So it did have a little bit of, a little wider range, had an outside day there, but it's still very tight. So I would buy it anyway. So the answer is, if you missed it there, the next day you could buy it, but it have to meet the same criteria. So the same criteria has to be met. That just come back to the same criteria. If you miss it, well, does it set up post you missing it? Does it set up with the criteria that you would need to have if you didn't miss it? If it doesn't, then it doesn't meet that criteria. Then there is no other special criteria. Let's just put it that way. So then I would leave it alone.
Okay. And I think on a single day, I think and Mark Ritchie, we've had this question many times during the question and answer Minervini private access. I think we kind of about 5 or 6% or more, we would not entertain that with that much of a move, retracing back to the breakout point. Mark, thoughts on that?
You mean which Mark? Sorry.
Either one, I guess. But on the same day, if you have a breakout, comes back in, if it's gone more than 5-6% or so, I think that's kind of a number as a threshold that starts getting too much of a reversal.
And the other question I would ask is, why did you miss the initial breakout? If now it's possible that sometimes you miss something, or there are times I might go limit to buy 5,000-10,000 shares and I don't get any, because if I'm only willing to buy 1% above the pivot and I try, or I get a really bad fill, then as it pulls back, again, assuming it doesn't run too far, if it pulls back, I will potentially add my position. I don't like to ever buy a stock that's just falling into me, though. Like, I don't ever want to be the falling knife catcher. I would rather wait to see it turn back up, even intraday, and then initiate the position.
Yeah, I don't like putting these numbers on it, Bob, and saying if it's 5-6%. All you have to do is look at the chart, okay? If the pivot is in single digits and it's tight and it has the volume characteristics, you buy it when it takes the high out. See, that negates all the other crap that you have to come up with. Everybody's trying to quantify everything. I've quantified it for you. VCP, right side, single digits. That's it. Takes out the high, you go. And so if you do that, you won't have to calculate anything. All you have to calculate is if that pivot is tight enough. And if it's tight enough and you've got the base build, the base is built out, and you've got those iterations in that VCP, and you've got all the characteristics, then you should be buying it and not measuring how much any one day was and worrying about if it was a squat and all this other stuff. That's just going to give you all reasons to not trade the trade that's set up perfectly. And you could go in there and you could start looking at intraday, and you could just boil this down and find some reason, to get away from your discipline. The least amount of moving parts. I'm giving you the least amount of moving parts. That's why we get these questions about price to sales, all these things. I've taken this down to the necessary things that you need to look at. But people, they're not happy with simplicity. They want complexity. and more things. I think more, more is better. More is not better. With this, and this is another thing that I learned from O'Neill. When I found out that O'Neill, all he did was look at bar charts. I said, okay, well, this is a real skill. This is because there's no formulas here, and you don't have to get all complicated with this. And us old school guys, we didn't have much to work with, so we learned how to utilize these few tools. But I found that when you start adding all these other things and indicators, oh man, it give you a reason to go long, short, hedge. I mean, it'll always confirm some idea. You'll never do anything.
A couple questions being asked about the two lower lows concept on page 399.
Yeah.
Actually,
what's the question?
A few repeated questions. If you could perhaps just review the concept on that again, because there's a few people asking similar to each other
So
questions.
this is something that David and I talked about for years and discovered and use in connection. This is when you're playing for a longer term move, you're using the weekly, and maybe you're in a stock that has made a big move and you want to stay with it. You want to stay with it. It's acting right. Maybe you just started a new bull market, stock's up quite a bit. What we found is that a stock can go a long distance. So a leading stock that's acting well, can go an awfully long distance sometimes without ever making more than two lower weekly lows. Now, if you're above the 50-day, and using this in connection, so maybe or the 10-week, if you were to wait and say, look, I'm not going to sell the stock until I see 3 weekly lower lows, and maybe close below the 50-day, and even say split it in half of my position on 3 weekly lower lows, half the position and close below the 50, you would stay in. Some of the leading stocks keep you in for 400%, 500%, 1,000% moves before they do that, or even half of your position. You sell half of it on below the 50, and you didn't make 3 lower lows yet, and it might keep you in half of it. Maybe the first part you get a double, and then the next part goes up another couple 100%. So this is what we were talking about with this, or what I was trying to illustrate. And you see here also, when you look at Burlington, look at the distance. It comes out of this really nice, perfectly formed big base. David Ryan and I were both buying it coming out of this base. He made this big fundamental case for it and got me on this stock. I wasn't even considering it that seriously at the time. But then it set up, and then I said, okay, I like the setup. It broke out, but you see here, all these little pullbacks and shakeouts, you might have got knocked out on if you're trying to play it for a big move. But if you just said, look, I'm just going to wait for 3 lower lows and a close below the 50, it would have held you all the way up until here, because they can go a long distance. The reason why is because institutions use the 50-day to add to, and they'll usually add to stocks on pullbacks of several days to a couple weeks. So as the stock pulls back for 4 or 5 days, that's why you get those 3, 4 lower lows. That's where they'll add to the position, because they'll try to buy a stock, it'll start running up, and then they'll back off of it because they don't want to defeat the purpose and run their price up. Now the stock starts pulling back, they start buying it again. Now it runs up, they back off, and that's how you get the footprints of institutional sponsorship, if you will, or accumulation. When that picture changes and goes the opposite way, that very often signifies that now the distributions come in, they're starting to liquidate, and the profit taking's coming in. And you'll see that if you go and look at these charts. It's amazing on how far some of these leading stocks can go before they make more than 2 lower lows. They're just another tool, another thing to gauge and to give you an idea whether you should be holding or holding it for a bigger move.
Question mark, if you missed.
And I'm sorry, real quick, Joe, I just want to say one last thing. Just show Shopify. Here, with Shopify here, it breaks out right here, right? See, a couple lower lows, just 2 lower lows. So you don't get the 3 lower lows. But look at all this volatility that goes through. Like this would probably shake out, a short-term trader, or even someone who's longer term, who's trying to stick with it, but is backstopping it. But you never get more than 2 lower lows. Yeah, and you get one close below we get a couple closes below the 10-week here. Right, this is the 10-week. Yeah, this is the 10-week right here. And so maybe you got knocked out of half, but this would have held you in. You would have held you if you used the 10-week and the two lower lows. You might have knocked out half here and then still in it here as it goes into a more of an accelerated advance, and you could sell into strength or even wait longer for the three lower lows. But see how it keeps you in even through this volatility. It's something to sort of keep perspective even as the stock is being volatile.
Since you mentioned the 50-day moving average trail, which is one of our selling techniques to get a bigger move, a couple questions were asking to better understand when does that kick in? When does the 50-day stop being?
So I very rarely, Bob is saying it's one of our selling techniques, but it is, but there's some explanation that needs to be said with that. It's not really, that's certainly not a secret selling technique. Selling below the 50 days is probably the most common thing that there is out there. Moving average, crossover or a close below the 50-day. But the time that I would recommend using that type of trailing stop is what we call the break even or better. And that's where the stock moves out of a base. And then when the 50-day catches up to the break even point, then you switch to the 50-day and use it as a trailing stop. And what I would use that during the times where, and we already talked about this, right? Didn't we talk about this in selling? Yeah.
Yeah.
Yeah. So we would use that when you're coming out of a bear market and say you buy some of the first stocks that are breaking out of bases, you might be on that key leader. You might have a tiger by the tail and you don't want to let go of that position too easily. That's a time where you want to try to hold, or at least a piece of the position. So that's where you switch over to these trailing techniques where you may not sell, into that first strength because it's just the beginning of a big move. And coming off of a bear market, that's where you'd want to use this and also be cognizant of the lower lows and maybe give the stock, three lower lows, as long as everything else is intact.
So the question is, when does that kick in? And that was when the 394 mark is the chart.
Oh, 394. Let me see. Okay. Oh, yeah. So we're on the break even or better. Yeah. That kicks in when the 50-day reaches the break even point. So you buy here breaking out. The 50 days down here, right? So you're just sticking with your normal stop at this point. Let's say it's 8%. Okay, so now the stock whips, bounces around here, and now it tightens up a bit here. Whether it goes up, whatever it does, doesn't matter. It matters what the 50-day is. The 50-day has now reached the break-even point. Once that happens, now you switch over to the 50-day, and that's what I call the 50-day break-even or better rule. So it gives the stock time. What this does, and many of these techniques I came up with for myself to trade, and also because I see a lot of mistakes that people make and how they get emotional and shaking around in the stock. So try to come up with techniques that people can keep them grounded. So what'll happen is you'll get all this whipping around and they won't stick with their stop. So, but if you start having some of these rules now, okay, you set your stop, and now as this catches up, you've got that trailing stop. Now it automatically backstop it. It sort of forces you to have a backstop and improve your worst case scenario. It's sort of a forced stop improvement to your worst case scenario. And then it creates a trailing stop now. So now you don't get shaken out maybe on some short-term move, and you're giving it a chance to make a bigger move.
Question here. Once we have found a buy point on the stock and made the purchase, if the stock goes down but is still above our stop loss level, under what circumstances are we able to buy more shares at this lower price?
I don't know, Mark. I don't know what circumstances are you buying. The stock goes down, doesn't hit your stop loss, and under what circumstance are you buying more?
Only if the subsequent buy point stands on its own. So rarely will I ever buy something. I almost never would I buy something below. I might buy something, say, around the same price. So let's say maybe the stock pokes its head out, and then you get 3 to 7 day reversal recovery, but it gets even tighter around the same prices. Then I'll potentially, maybe even double the position up. Or if it's really small, I might go to a full position, assuming things are working. But I'm not just going to be blindly pyramiding a position just because the stock is, certainly if it's lower, that usually means my timing was off, and I don't ever want to be, averaging down.
Yeah, I would almost never, ever do that. And why would I want to add to a position that's showing me that it's not it's not working. Like that's the complete opposite of what you want to do. You want to add to positions that are working and cut back positions that aren't working. So maybe if it pulled back and then set up a pullback buy, some, like Mark said, if the pivot point or the buy set up in a way where it stands on its own, like I would buy it anyway, even if I wasn't in the position, yes, then I might add to it. But when it pulls back maybe to your danger point, which was maybe where your stop is, and it gets close to that, now the risk is pretty low. But it would still it wouldn't, just the stock coming down, I would not buy it just because it comes down. It would have to set up again. It would have to stand on its own 2 feet for a constructive setup. Is again always thinking risk reward and always requiring the entry criteria. When you do it this way, you're playing aces and kings and queens all the time. You're not going to win all the time. And when we're not, there's times we go long stretches where it's just one stop after the next, but we're not going to just sit in there and get our head caved in. We're going to trade small. We're going to wait. But again, there's been times, anybody who's a poker player knows, they lost with good hands and for sometimes months. They call it going card dead. You can go card dead. Bob plays a lot of poker and played a lot of poker in his day. Bob, well, how long have you gone card dead where you seem like you could never win, right? I mean, you can go
in
months.
A tournament, final stages of a tournament, the worst.
Yeah, that's what it seems to always happen. But yeah. So I played lots of poker when I was retired for a number of years. I played poker every week, 4 days a week, and at a very high level. And I went card dead sometimes for 3 months. I seemed like I couldn't get a hand, but just really tough environment. So same thing happens, with trading.
Yep. I'm not sure I'll read the question as it's written, but I'll let you answer, Mark. You mentioned that going from stage 2 to stage 4 can take 2 to 5 years, sometimes decades. So you're just wondering why, let's see. So just wondering why we think in private access that the market can get back to stage 2 sooner than 2 years. I don't think you ever said it always takes 2 to 5 years.
Yeah, I don't know. That sounds like there's more words put in my mouth than I could possibly fit. I don't even know what the question is.
Yeah, the main gist of this is for the person who asked the question. Yes, it could take 2 to 5 years or even decades, but it could also take just a matter of months for a stock to transition from a stage 4 into a new stage 2.
All of that is correct.
A question here regarding over trading. This individual has basically no power to sit on his hands when he's in front of the computer screens. He just has the need to take a trade. So he's asking, in this circumstance, would it be okay, or is it a profitable strategy, is the question he asked, to put in orders and have your stops orders as well entered and walk away from the screen until the end of the trading day?
Sure. But I think, that's also like, taking, being a smoker, or not putting yourself in a situation where maybe you succumb to drinking alcohol and you just stay away from bars, which is that's a good practice, but you really want to get to the point, to really empower yourself, or to be in control. You'd like to get to the point where you could be around that environment and you don't succumb to it. So first of all, the first problem, that's the huge problem, is that you're saying you're not in control and you can't sit on your hands. Well, you're right then. I mean, as long as you say that, that's exactly right. But the fact is that I don't understand. Someone else has got a hold of your account, like they're pressing the buttons. You are in complete control. You're just making a choice. You haven't convinced yourself. And the real answer is that you're not trading for performance. You're trading for another reason. You're trading for excitement. So you might be better off, going to Vegas and playing poker or doing, something. So you're just, the reason why you're trading, your why is not the why. You're trying to perform, but your why doesn't match with it. This goes back to, in my mindset book, I talk about, look at your values, what values you want to live by, and then look at how you're living. And Do they match? And the whole goal is to then bridge the gap between the two. The same thing with trading. What do you want to accomplish? And then what are you doing? How are you living? How are you trading and what do you want to accomplish? And do you have to bridge the gap between the two? But that's a personal decision, a choice, for you to sit on your hands is, I guess, you're just not convinced yet. We can't, sometimes we convince people, but usually they have to learn on their own, and they either get beat up over long enough where they get demoralized to the point where they just quit, or they learn. I always often say the market is learn or burn. That one of the two are going to happen. You're either going to learn or you're going to burn. There's no way around it. Over the long term, if you don't learn the lessons and apply them, you'll blow up. The market will take all your money and leave you broke and broke, busted, and disgusted. So that's my best advice. Can you put the orders in? Absolutely. Absolutely. You can put them in, and that might be best for you, is to put them in and use mechanical stops. But I think you'll override that too, because you're not getting what you want to get out of it. You want to get excitement, and that's not going to be exciting to you.
Yeah, mindset for secrets for
Read
winning.
my mindset book if you
Very
haven't
highly
already.
encouraged for people with need to fix things like that. Mark, in the chart that you show, the low cheat, the cheat, and the handle entry points, do you have any historical batting average statistics that show you one of those areas performing better than others?
What page? Is there a page? I mean, I know,
But just that chart
okay.
where we show.
Yeah, but I just want to, for illustration purposes, to show everybody. I think where's the where the three, where I have the diagram
186
broken into thirds. Yeah,
186.
Yeah, let's see. Let's go there. Let's just show what we're talking about. So we're talking about the low cheat, the cheat, and the handle. Which the low cheat is in the lower third of the base. The cheat is in the middle third, and the handle is in the upper third. That's just our our vernacular or semantics of it. Now, the question is one of these a higher probability than the other? So what I found is that it depends on the environment. Okay, in certain environments it's thematic, and in certain environments the low cheat will work better. So you've got to sort of just bend towards the theme. But over the long term, in my own anecdotal evidence of what I've seen, is that the cheat and the handle is higher probability than the low cheat, but the low cheat offsets the difference in probability by getting in lower and having more upside potential. So they're about even. When it's all said and done, they're about even. In the later stages of a bull market, the handles are more obvious and they're lower probability. But we're talking a very small amount of difference in probability. They're pretty similar probabilities if you get the chart right. If you read the chart right and the environment's right, it's just a matter of some stocks set up in different areas within the chart there, and the outcome is usually very similar as far as the overall probabilities. Mark, I mean, just in your own trading, you were able to go right away and know exactly how many power plays you played. I mean, so you obviously keep good control stats on your trading. Do you have any evidence of what has worked better for you?
Yeah, it's funny. I don't have every single setup labeled. I only went back through, based on the power play study I did in my own numbers that I referenced in that section, and sort of pulled out every single one of those. But yeah, anecdotally, I would say it's about the same. And actually, low cheats weren't something I learned early on as well. I can't remember when you even added that officially to the program. I think that was a couple of years later, because I remember even asking you about that. And you're like, well, it's something, I've been trading, but I just didn't put it in the earlier iteration. So, but yeah, I think the difference is it's also one of these where it's hard to know, because sometimes based on the theme, you get a lot of cheats, you don't get a lot of handles. You know what I mean? So I think of it in terms of, if we get a wave of setups, I don't go, well, I just want to play the cheat, not the handle. I want to see the setups. And then I default to trusting those. And, which one sets up in what part of the cycle, to me, isn't really as important.
Okay, so two things. One is, I get really nervous when somebody asks a question like that, because it starts to show that you are looking for a bias to say, well, I'm just going to play low cheats because they're the higher. Like if I told you that the probability is much better for the low cheat, you might say, well, why play handles and cheats? Well, then you might miss an entire bull market or miss some of the greatest stocks because they set up from a handle. So you really got to just take it. It doesn't really matter. Take the setups. When the setups come, these are all equal. Think of it as aces, kings, and queens, right? They're all premium hands. You want to basically play them. You're going to play aces and kings pretty much the same. Queens a little bit differently, but pretty much the same. Those are premium hands. So just think of them as premium hands. What was the other thing? I forgot the other thing I was going to say. I forgot. Sorry.
Getting a little long in the
I
day
had
here.
2 points. It's getting long. Yeah. I've been trying to write some of things down just so I don't forget. But
And one thing I'll just add in there too is obviously a lot of people have that mindset: get in lower, you'll get more profit when it works. But keep in mind that probability is not going to be, which is where Marcus is highlighting, as likely to have success with low cheat. That's sort of the give and take. So a lot of times Mark, when he does enter low cheats, not all the time, but sometimes he'll take smaller half-size positions as a starting point to get in, knowing that there's a higher risk in that entry point than when the right hand side's more developed and constructive with a cheat, or even more so with a handle.
Oh, I remember what I was going to say, because it was related to you, Mark, of saying that, Mark said that in the beginning and the earlier MTPs, I never even mentioned the low cheats. And that's true for two reasons. One, I refer to it as you go down in the base, I refer to them as expert buys. The reason why is when you get to a low cheat, this requires more skill and expertise because you've got more supply to the left now, and you've got to assess that, and you've got to do more analysis of the price and volume and have a better understanding of that supply and what it means and how it's being digested. So it is more of an expert buy, and I had not used them long enough to really conclude what I needed to before I shared it with others, and had other people go out there and using it with their real money. I gotta make sure that my research is solid. And then when I got to the point where I felt like, okay, I've figured out a way to teach this and it's definitely valid, then I started sharing it and it became part of this curriculum.
Mark, I would add too. I think I find the pullback buy also to be more of a pro buy. Just anecdotally, it wasn't something I used for a number of years because I didn't feel like I was good enough at using it. So I do think in some level some of these are more intuitive than others for some folks.
Yeah. And you'll grow into this as you see the cheat. You'll start to see the low cheat because you'll see them in relation to each other. Once you learn, you're not, a lot of this stuff, it's so illustrative, and the way I teach is with so many metaphors and anecdotes and examples and all these slides. You'll be looking at charts in a whole new way, and you'll be thinking in a whole new way. Certainly after risk management and mind-blowing math, I promise you will never think the same when you look at trading. So you'll develop. What's up, Bob?
Go ahead.
Yeah, you'll develop into this where you may not spot the low cheats as well in the beginning. The handles are going to be easier to spot because you've got that right side is developed, and they're just easier. They're closer to the highs. And as you go down and you go to the cheat, then the low cheat starts popping up and you go, oh, I see that's forming before. And it becomes relative to each other. And you start to see how those three floors, if you will, for lack of a better term, appear, and sometimes don't appear at all, or there's only one of them, and sometimes there's two. You'll get a low cheat, it'll run right up and the handle, but just think of it in the thirds. So if the stock forms a little pivot near the lows, maybe you don't buy it, it runs up, and then it forms a handle. It might have shot through that middle third, and you never got that middle third cheat, and you got that, or it just runs right up off the lows and then drifts back and forms a big handle, and you never got a low cheat or a cheat. Or sometimes it comes right off of a low cheat and just takes off. And that was Google, Twitter. They came off of the IPO base. They formed a low cheat. They just took off, and they never formed a cheat or a handle. So, but once you get all this, you'll very rarely miss any stock that's taken off from a base, because you'll be able to grab it somewhere along the line, within the base. That's the key, is you want to buy it within the base to just as it's coming out of the base. That's the safest and most predictable spot where you can ascertain like what is it's supposed to do post. And then that's the key. The key is having a set of parameters that what's normal and what's abnormal from that reference point. Then all your decisions from there are just responding, and you just have to improve upon your ability to respond, and that's what it's all about.
All right, we've got one last question before we wrap up for today's question and answer. Remember, I know we didn't get through every question, but we will have another session on Monday during the live trading day. Similar type of question though, Mark, going to page 112.
Okay.
And in the predictive, coincident, and confirming stages of a leading stock relative to the market, the same question was being asked of the batting average of each, if there was any statistics you had of that.
Oh, this is definitely, would me be shooting from the hip, as far as I don't have anything really to quantify this whatsoever. But I could tell you right now, predictive there's going to be a lot less stocks. All right. The stocks that really start setting up and you get lots of setup are going to happen after the market bottoms. It's going to be confirming or even later. And I think Mark, you said something about this when we were talking about the COVID bear market low, and then how I said, we started buying around April 6th. And then as it went on, I think you said, you weren't really even starting to really get heavily invested in buying a lot of stocks. It was till like July, I think. And that's sort of how it happens most of the time. But the reason this slide was in relation to finding the key leaders. The stocks that are the strongest are the ones that hold up during the bear market, and they break out first. And by the time you get to down the road, where you still might have tons of tradable stocks that are coming out of bases, and you get great swing trades, those leaders that were the Amgens and the Amazons in their day and Netflix have already taken off. And this is where I missed these early in my career. I was constantly missing the leaders because I was waiting for the confirmation from the market. By the time the market got in an uptrend and it was so obvious that the market had bottomed, the leading stocks were long gone, and I was always buying laggards. So this is just to illustrate that opportunity that you have when in a bear market, that you shouldn't be taking time off. That's where you watch the most carefully and look for those stocks that are holding up, because the best ones are going to bottom before the market. Mark, any final comments on that?
Yeah, and I think that the point I had made is that generally I just made the most money in those confirming periods, and just to let people know that you don't have to be in a hurry. And usually I take that predictive, coincident, and whatever names I have, maybe even smaller size, that are working, I lean on those gains during during that confirming period then to get really aggressive.
Yeah, and during that confirming period, you're going to have more opportunities, and you're going to have a higher batting average. Like stocks are going to be working more because, again, by those lows where you're bottoming in the market, there's a lot of volatility usually, and that's where, yes, the leaders will stick out, but you're not going to have a lot of opportunities, but you're going to have probably some of the best opportunities. Later on, you're going to have a volume of opportunities and more certainty, and that will offset it. Like, again, I've made majority of my money trading the swing trades and not getting those big winners. But so I'm just trying to show you, just like in the base, you have these various spots to get on board. Well, this is illustrating a bear market where you have various spots to get on board. Once you start having all these, I'm trying to give you a whole toolbox, or my toolbox. I'm giving you my toolbox. Like Mark said, we're not just going to use a screwdriver. We've got multiple tools and to use depending on the situation. Sometimes you got to saw a piece of wood and then you got to screw it. And we have to have different tools. And that's why this is not a pure science. We've quantified a lot, we're systematized it, but when it really comes down to it, there's a lot of art here, and it requires skill and ultimately expertise, experience, and that will come. And then at some point, you'll be the next Mark Ritchie, and who knows, maybe one of you will be my co-instructor going forward.
Mark, one last question, because it does play right off what you just said, and that is, just as the best world-class chess players can no longer beat AI computers, do you believe the future AI will ever create a software program that will beat human beings from trading. And so since you just sort of related to the art as opposed to pure science, I wanted you to answer.
Absolutely not. Well, first of all, to beat the average human being, absolutely. I mean, throwing darts will beat the average human because it's more systematic. The average human being is riddled with emotions, but the average person loses. So the answer would be yes on average, but will the best computers beat the best traders? Absolutely not. And will AI ever like take over? Like people are so worried about that AI is going to take over and human beings, we won't need human beings to make decisions. That's ridiculous when it comes to something like the stock market, because again, if that were the case, everything would become efficient. If the computers could figure everything out and you can quantify this and put it into a spreadsheet and a computer program, because the computer thinks linear, everything would be efficient. There would be no opportunity. So who would want to trade the stock market if stocks went sideways essentially and it was a true random walk? It's not. And if it got to that point, let's just say computers took over human thinking, well, wouldn't we shut the computers off? I mean, wouldn't you, if they took all our jobs? I mean, unless they're going to literally take over where we can't shut off the machines, but if they took my job and they took all our jobs, I think we would have to say, just like cloning. Once they cloned the sheep, the community said, this is a little bit, too powerful here. Maybe we should back off, and this isn't something where a road we should go down. It's the same thing would happen with AI. But as far as the market's concerned, it's even much simpler than that. We get this question constantly where, well, if this is so good, why isn't everybody doing it? And if everybody did it, would it still work? No, it wouldn't work. If every single person that was trading stocks did our strategy, it would not work. And guess what? Then they'd stop doing it and it would start working again. And that's it. And that's what happens. That's why in some periods it doesn't work as well. And in other periods it works great. It ebbs and flows. But that's part of it. That's what creates the opportunity. That's good. That's not a bad thing. That's a good thing. Okay, so something to work in perpetuity and work every single day, every year in perpetuity is impossible. You could never, if that was possible, there wouldn't be the opportunity. You have to have inefficient pricing. You can't. You have to have two, just like in a negotiating deal. There's got to be, if we were to go in business, and I were to sell, and everything was perfectly priced, and I would sell a product for what I paid. Well, who would go in business? You wouldn't make any money. You'd break even. But the fact is there's an inefficiency there. I buy something at a certain price, I put in some labor, and somebody's willing to pay a little more for it, and there's a profit involved. If we made that perfectly efficient, then nobody would go into business. Same thing here. So,
I would just add real quick, just anecdotally, that a game of chess is far more simple with two players than a massive multivariate system like the market. Not saying AIs won't do well, some computers won't do well trading, but the idea, the analogy in my mind is a little bit spurious as well.
But chess has there always is a perfect move. There's always a perfect move. It's mathematical. It's linear.
Yeah, it's perfect information. It's all in front of you.
Right. There's no perfect. This is a dynamic, changing thing. Just like a company. Who's to say the company's their earnings are gonna come out 100% a quarter for the next 15 quarters, or if all of a sudden next week, there's the CEO is going to get in a plane crash and the visionary of the company dies. I mean, there's so many factors involved, and it goes way beyond that. But the answer is absolutely not. Don't concern yourself with that.
All right. So with that said, guys,
long after we're all gone, this game will still be going on the same way.
We're going to wrap with that. Today's question and answer session with the 2022 Master Trader Program. Appreciate all your questions. They are really good ones. And again, as a reminder, we will have a replay tonight, 6 p.m. Eastern time. So just after a few hours, we'll do it all over. And same login information, same credentials. That will also be for day 4 of the Master Trader Program, being tomorrow, 9 a.m. Eastern time, with a replay tomorrow night for day 4 curriculum. And then on Monday, November 21st, we will have the live trading day. There is no replay of that, just as a quick note. We will be starting a little bit earlier with 8:30 on that pre-market routine with Mark. Actually, it's that we're going to start at 8:30, so we'll have the room open 30 minutes beforehand. And with that said, any other questions, we will have time for that on Monday, time permitting, as well as the Marcus Smith presentation from Scott St. Clair. So
Pay close attention tomorrow, because this is really what it's all about: risk management, and this is the real final finale of which I think is the real eye opening. I'm sure you've had a lot of eye opening aha moments already, but this is going to be the real eye opener. So pay close attention, take lots of notes. We'll see you tomorrow.
All right. Thank you, Mark, and thank you, everybody. We'll see you soon.
Okay. Thanks, guys. Bye bye.
Recording stopped.